Segregated Funds and Annuities. Chapter 1. Investment and Savings. Competency Components. Assess the client's needs and situation. Analyze the available products that meet the client's needs. Implement a recommendation adapted to the client's needs and situation. Competency subcomponents. Determine the client's situation, investment objectives, and investor profile. Articulate the client's needs based on the risks that could affect his financial situation. Analyze the advantages of segregated funds in comparison to other types of investments. In regard to the client's needs, propose a recommendation adapted to the client's needs and situation. 1. Investment and savings. Segregated funds and annuities are investment and savings products marketed to individual and group prospects and clients. Segregated funds are exclusive to the life insurance industry. Only licensed life agents can represent segregated funds. Some annuities are also exclusive to the life insurance industry. Others are sold both by licensed life agents and by other financial institutions, such as banks. Segregated funds and annuities provide guarantees to investors. They can help some investors reach their financial objectives, such as retirement. Many options are available for those who save, and have the desire to invest those savings. Every option has features suitable for some investors, but not others. The life agent has a duty to clients to identify which investment is in their best interest to represent information fairly and to know the limits on the advice he is authorized to give. 1.1 Investment and Saving Principles. There are certain time-honored principles that apply to investing and saving. It is essential to understand these basics, which are the foundation of all investing and saving, before focusing on segregated funds and annuities in particular. 1.1.1 Concept of investing. Investing can only begin when an individual has savings in the bank or has the ability to set money aside from income that can be earmarked for savings. You may find that some coaching is required to get your client on the path to saving, so that investing can begin and wealth is accumulated. How can saving be simplified and encouraged? There are some old standby methods that have stood the test of time. They include: pay yourself first. Make savings an item on the budget, just like any other expense. This reduces the temptation to spend. For instance, a pre-authorized contribution, PAC, or pre-authorized deposit, PAD, to a savings or investment account is a highly effective way to build savings. Save 10% of take-home pay. Exactly as its name says, but the percentage may need adjustment according to individual circumstances. Save exceptional payments. Save money received from an income tax refund or a work bonus. Set up savings buckets. A savings bucket has a dedicated purpose. It is rewarding to see savings goals for specific objectives being reached and can reinforce savings habits. Buckets could include retirement, holidays, or big-ticket items such as a car. Budgeting. Budgeting is crucial for managing day-to-day finances and allocating a sum for saving. When savings have accumulated or can be earmarked, then it is time to start considering how to grow that money through investing. Investing is the process of using savings to purchase investment products with the goal of making money. A business invests money in new equipment, for instance, that will help it make more products faster or cheaper. The business profits from its investment. The goal of individual investors is to invest a sum, called principal or capital, in an investment product that will be repaid to the investor plus a profit. That profit is called the return. Many investment products are available for individual investors. Some investments guarantee that the full amount invested will be repaid plus a profit. These investments include guaranteed investment certificates, GICs, and some bonds. Other investments do not guarantee that the amount invested will be repaid. These non-guaranteed investments include stocks, mutual funds, and real estate. Example: Jean is 78 years old and depends on the returns from her investments to generate income to support her in retirement. Her investments, combined with her pensions, allow her to live comfortably. Jean feels that she cannot afford to risk her invested money in an investment that would not pay both her principal plus the stated return. Therefore, Jean chooses guaranteed investments to ensure that she will not experience losses. Where does segregated funds and annuities stand in respect to such guarantees? This chapter and this manual describe how these insurance investments provide guarantees, to whom, and when. 1.1.2 Investment Basics. Some investment basics are fundamental to understanding how investing works, how returns are generated for investors, and how investors manage risk. 1.1.2.1 Compounding. Compound interest. Compounding is a concept that is basic to investing. It is a very powerful investing tool. Interest on an investment may be paid daily, monthly, quarterly, or annually. The investment may permit withdrawal of the interest or for the interest to be added to the value of the investment. When it is added, or reinvested, the value of the investment grows. At the time of the next interest payment, interest is calculated and paid on the total investment value. That value is a sum of principal plus interest previously paid. As a result, the investor earns interest on interest. This form of interest is called compound interest. In order for compounding to work to its maximum potential, all investment returns must be
reinvested. Withdrawals diminish or eliminate compounding. Unfortunately, compounding also has a negative side since costs can also compound. Debt, in which an outstanding unpaid balance is charged interest, also compounds. 1.1.2.2 Investment returns. All investments have one of three types of return. Returns can be positive and reflect a profit earned from the investment. Returns can be neutral, in which the investor receives the sum initially invested plus any fees paid. He is back where he started. Returns can also be negative. In this case, the investor will not receive back all the money invested. This is a risk of investing. The return is often expressed as a percentage of the amount invested. In those cases, it is called rate of return. It can be a positive number, such as 10%, or a negative number, such as -10%. Example: Salim invests $10,000 but receives $11,000 when he sells the investment. The $1,000 profit, $11,000 to $10,000, is a 10% rate of return. $1,000 divided by $10,000. In some cases, investors may be informed of the expected rate of return on an investment before they invest. In others, it is impossible to tell investors what to expect because the return cannot be accurately predicted. This is a characteristic of a risky investment. There is also a scale of risk expressed for investments, which is a guide to the investor about how likely it is that he will receive all his money back. The scale of risk plots the amount of risk an investor takes on in a range between the bottom of the scale, which is very low risk, and the top of the scale, which is extreme, called speculative risk. An investor with a very low-risk investment can be very confident that he will receive back all his invested money. Speculative investments are the most risky. An investor who makes a speculative investment knows that he may not get back all the money he has invested. There is a very high degree of risk that he will experience a negative return and lose money. However, there is also a possibility of very high returns and earning a significant profit. Moderate or balanced risk investments are in between the two ends of the risk spectrum. Why would an investor consider risky investments? Risky investments provide the opportunity for far greater positive returns than those with lower risk. This concept underlies investment risk/return theory. It is based on rewarding those who are prepared to risk their money with a better return. Investors who are not willing to risk the loss of their money receive a lower rate of return. Returns are classified as nominal returns or real returns. A nominal return is the stated or advertised rate. For example, a savings account is advertised with a 2% return. That is its nominal return. Real return is calculated as the nominal return on an investment minus the rate of inflation. It can be positive, showing a profit, or negative, showing a loss. Example: in 2020, if the annual nominal return on a guaranteed investment certificate was 3% and the annual rate of inflation was 1.8%, then the real rate of return on the bond was 1.2%, 3%, 1.8%. In 2022, if the annual nominal return on a guaranteed investment certificate is 3% and the annual rate of inflation is 5%, then the real rate of return on the bond is -2%, 3%, 5%. 1.1.2.3 Asset classes. Asset classes are categories assigned to investments that have similar characteristics and are governed by similar laws and regulations. The three main asset classes are stocks, also called equities, bonds, also called fixed income or debt, and cash, also called money market instruments. Two other classes are often added. They are real estate and commodities. Each type of asset class has its own risk and return features. Asset classes are fundamental to the investment concept of diversification. 1.1.2.4 Diversification. Diversification is a strategy used in investment portfolios and pooled investments. It combines asset classes and investments within those classes to spread out investing risk. Therefore, diversification in a portfolio lessens risk, based on the well-known theory of not putting all your eggs in one basket. Diversification can be accomplished in many ways. It could be through buying stocks of a wide range of industries or companies, and bonds with varying interest rates. Another form of diversification uses foreign investments to take advantage of different economic conditions in other countries. This spreads risk over national and foreign investments and their respective economic conditions. When an investor buys into a pooled investment, like a segregated fund, he automatically receives the benefit of diversification. Each segregated fund is invested in a wide range of investments specific to its type. For instance, a bond fund is diversified across a broad spectrum of bonds in its portfolio that mature at different times, have varying degrees of risk, and make payments at different interest rates. Other investments that offer similar diversification include mutual funds and exchange-traded funds, ETFs. When an investor buys one stock or bond, or 10, or even 100, he is not receiving the full benefit of diversification. Point 1. Risk is centered on performance of those individual investments. If they lose value, there are not sufficient offsetting investments to compensate for losses. Therefore, it is very difficult for an individual investor to achieve diversification unless he invests in a fund-type investment. Most investors simply do not have enough investment capital to be able to achieve adequate diversification in a portfolio of their own stocks and bonds. Those that do often rely on investment professionals for frequent advice. 1.1.2.5 Liquidity. Liquidity describes the ability to cash in, or sell, an investment quickly at or near its current market price. An investment that has characteristics of liquidity is called a liquid investment. A savings account is a liquid investment because some or all of its value can be quickly accessed for use. An investment that does not have characteristics of liquidity is called illiquid. Real estate is often cited as an example of an illiquid investment since considerable time could elapse between the sale of a property and receiving its proceeds. Liquidity is essential in an investment when a part or all of its value will be used to provide an emergency fund to an investor. An emergency fund is a portion of earnings set aside for emergency purposes, such as when there is a sudden need for income due to an unexpected job loss. When such a need arises, the investor must be able to quickly and easily sell his investment and obtain its highest market value. 1.1.3 time value of money. The present value of money is one aspect of the principle known as the time value of money. The future value of money is the other. It is very important to understand the differences between the two. Both principles are based on the potential for invested money to increase in value over time due to interest being earned. They do not consider investment growth due to other factors, such as capital gains. 1.1.3.1 Present value. Understanding present value, PV, and being able to calculate a present value sum is essential to many financial planning activities. Present value works backwards from a future date. It answers the question of how much is needed now to achieve a future savings goal. Therefore, it would be used to help a person determine how much needs to be saved today to yield specified retirement savings at a future date. Likewise, a parent who must meet future post-secondary education costs for a child could be provided with that information from a present value calculation. Present value tells us that if $5,000 is needed at a future date, then less than $5,000 needs to be saved today because today's sum will earn interest and grow over time. The higher the interest rate, the lower the initial sum of investment needs to be. The present value calculation is performed when the future sum is known, the future date is known, when the sum is needed, and when the interest rate between today and the future date can be specified. Present value is generally calculated using a calculator, through an online resource, or with software provided by insurers. It applies to both a sum of money and cash flows. The formula for the calculation is PV equals FV divided by 1 plus interest rate, N. FV is the known future value and N is the number of periods for the calculation. Example: Julie wants to know how much is needed today to provide $5,000 in 5 years. Given the current annual interest rate on savings of 3%, the present value of $5,000 in 5 years based on 3% interest earned is $4,313.04. PV equals $5,000 divided by 1 plus 0.035. Julie needs to invest $4,313.04 at 3% interest today to equal $5,000 in 5 years' time. As interest rates rise, the amount needed for investment to arrive at the same end sum, $5,000, decreases. If Julie wants $5,000 in 5 years, given a 4.5% annual interest rate, she only needs to set aside $3,994.26 now. $3,994.26, PV equals $5,000 divided by 1 plus 0.045, 5. 1.1.3.2 Future value. The future value, FV, calculation answers the question of how much a sum invested today will be worth in the future. Therefore, if a future retiree has a certain amount saved for retirement purposes now, he can determine how much that amount will be worth at retirement in 10 years. Using a future value calculation. The calculation is performed when today's amount of investment is known, the future date is known, and the interest rate between today and the future date can be specified. Like present value, future value is generally calculated using a calculator, through an online resource, or software provided by insurers. The formula for the calculation is FV equals PV times 1 plus interest rate, N. PV is today's known sum, present value, and N is the number of periods for the calculation. Example. Sam has $5,000 today and wants to know the value of that sum in 5 years. Given the current annual interest rate of 3%, the future value of $5,000 in 5 years' time at 3% annual compound interest is $5,796.37, FV equals $5,000 times 1 plus 0.035. Sam will have $5,796.37 available for his needs in 5 years if he invests $5,000 today at 3% interest. As in the previous example, a higher interest rate works in favor of the investor. This is because Sam's savings grow greater over the 5 years, thanks to the higher interest rate. He will have $6,258.98 in 5 years when he invests his $5,000 at 4.5% interest. $6,258.98, FV equals $5,000 times 1 plus 0.0455. 1.2 Investment Objectives. Investors have many reasons for investing and saving. Their reasons are called their investment objectives. It is important for investors to articulate their objectives to their agent since the purpose of investing and any time constraints will be the basis for many investment decisions. Investment objectives can be classified as short-term, medium-term, or long-term. A short-term objective is a goal to be reached in 3 years or less. Medium-term is the period between 3 and 10 years, and long-term objectives are 10 years or more. An example of a short-term objective would be saving for a holiday next year. Medium-term objectives could include saving for a new car or for the down payment on a home in 5 years. One of the most common long-term objectives is saving for retirement, which might be many years in the future. Investment objectives for individual clients are very different from those for groups, such as a group of employees covered by a pension plan. While the individual focuses on his specific needs, a group plan focuses on the needs of the group administrator, which is usually the employer. Its goal is often to offer an employee benefit by providing a retirement pension to their group. By providing a plan that helps to attract and retain quality employees, the plan serves the goal of the employer. Knowing the client is the key to understanding his investment objectives. 1.2.1 Account Purpose. Many forms of accounts are available to meet investment objectives. It is important to align the proper account with the appropriate investment objective. Here are some forms of accounts available and their purpose. Registered Retirement Savings Plan, RRSP. Retirement. Registered Education Savings Plan, RESP. Post-secondary education costs, usually for a child or grandchild. Registered Disability Savings Plan, RDSP. Income for a disabled dependent. Tax-free Savings Account, TFSA. Tax-free Investment Growth. Registered Pension Plan, RPP. Retirement savings for members of a group. These accounts are all examples of registered accounts. Registered accounts are individually registered in the account owner's name with the Canada Revenue Agency, CRA, to provide tax benefits. Non-registered accounts are also available for savings and investing. They have flexibility for deposits and withdrawals, unlike registered accounts. Although not registered with CRA, returns must be reported to CRA for tax purposes. It is important to recognize that the account itself, whether registered or not, is simply like a shopping bag. The bag is empty until savings go into the bag, and those savings are invested. Investors typically shop around for the best investments for their savings. Their investment choices determine account performance. Therefore, a person cannot be dissatisfied with owning an RRSP, for instance, since the RRSP is simply the account type. He can be dissatisfied with the types of investments he has selected within the RRSP because they are not performing adequately to meet his retirement objective. Those investments can be removed from the account and replaced with others to achieve the account performance that will satisfy his investment goals. 1.2.2 Financial Goals. A financial goal is a dollar figure associated with an investment objective. For example, an investment objective is retirement at age 60. The financial goal is to have $800,000 saved in an RRSP at age 60 so that retirement can begin. Financial goals are a target that investors can work towards. They are a powerful motivator to begin saving and investing, continue saving and investing, and monitor investment performance. 1.2.3 Need for guaranteed investments. A guaranteed investment is an investment that makes a guarantee to its investors. The guarantee may be to pay back some or all of the money invested at a future date. That guarantee might be enhanced by also guaranteeing that a specified return will also be paid to the investor. Guaranteed investments are safe investments. They have less risk than investments that do not provide a guarantee. They appeal to investors who are not risk takers. For the most part, their returns are lower than investments that are not guaranteed. Guaranteed investments offer investors great peace of mind. Investors know the minimum amount they will receive and when they will receive it. With some guaranteed investments, such as annuities, there is no need to monitor investment performance or be concerned about ups and downs in the stock market. Investors who have predetermined obligations, such as the need to pay university tuition for a child at a set date in the future, can rely, for example, on guaranteed investments to meet their obligations. Finally, guaranteed investments are often the preferred investment choice for those whose ability to earn an income from working is restricted. This is often because these individuals are either nearing retirement or have already retired. They do not have the capacity to recover from losses on investments where the principal may not be repaid. They need their principal returned because they are no longer able to regenerate that sum through employment. 1.2.4 Time Horizon. A time horizon is a future event when invested money will be needed to meet financial objectives. For example, the time horizon for someone saving for retirement is the date of retirement. Time horizons are unique to each individual and objective. It is possible for an investor to have many different time horizons based on different objectives. He may have a time horizon for buying a new car, buying a second home, starting a business, paying for post-secondary education, and retiring. As a result, he may have a different time horizon for each saving or investing account. In general, those who have a long time horizon have the ability to invest more aggressively, or with more risk, because they have more time to make up for investment losses that may be incurred as a result of assuming higher risk. The time horizon is closely related to the concept of the time value of money, both present value and future value. Calculating such values provides answers about how much is needed for investment now to meet the stated time horizon or how much will be available at the stated time horizon. Example: Martin has just received an inheritance of $200,000. His time horizon to retirement is 7 years. If he can assume he will earn 4% per year, in 7 years' time his inheritance will be worth $263,186, FV equals $200,000 times 1 plus 0.04, 7. 1.2.5 Tax-advantaged investing. For tax purposes, investment returns are classified as interest, dividends, or capital gains. Each form of return is taxed differently. It is important to know that even though taxation varies, returns are usually the objective of investing. Even though interest is taxed at the highest rate, an investor does not want to avoid receiving interest due to the tax he will pay. Interest is taxed at the same rate as income earned from working. There are no tax advantages to receiving interest. Foreign income, including foreign dividends, is taxed as interest. The marginal tax rate of the investor applies to interest income. Dividends are paid quarterly by companies from their earnings to their stock owners. Not all companies pay dividends, and there is no guarantee that a dividend will be paid. Investors with stock in qualifying Canadian companies who receive dividends may benefit from the dividend tax credit. As a result of the tax credit, which reduces tax, the dividends are taxed at a lower rate than interest. The investor's marginal tax rate is applied to the balance after the credit has been applied. Capital gains result when the sale of capital property, such as stocks, is higher than its adjusted cost base, which is primarily the cost of purchase. Capital gains tax is the lowest rate of investment taxation. Only 50% of the capital gain is taxed at the investor's marginal tax rate. Another tax advantage for investments that earn capital gains is capital losses. If an investor loses money on an investment, he incurs a capital loss. Although a capital loss means an investor has lost money on his investment, half the capital loss can be deducted from taxable capital gains on other investments. The loss must be used first against capital gains in the year the loss is incurred. However, if capital gains are unavailable or insufficient in that year, the capital loss may be applied against capital gains in any of the 3 previous years, or in any future year. This reduces the amount of taxable capital gain and the tax to be paid on that gain. The lowest risk investments tend to pay interest. Those that generate capital gains are the riskiest. Therefore, the investor who chooses the riskiest investments can benefit from the opportunity to earn a higher rate of return and from the tax advantages of these investments. 1.3 Types of investments. A life agent license allows sales of segregated fund and annuity investments. These are just 2 possible types of investment in the total universe of investments. Investors may be satisfied learning only about these investments. However, it is far more likely they want to compare many investments to identify the investment most suitable for their objectives and risk tolerance. For instance, an investor may want to compare segregated funds with mutual funds. Therefore, it is necessary for the agent to understand other investments. This allows the agent to make useful and accurate comparisons of investments to best serve client needs. Having an understanding of other types of investments also allows the agent to better understand segregated funds. For instance, an agent who understands stocks and stock market behavior can better explain equity segregated funds to investors. 1.3.1 Segregated funds. The legal term for a segregated fund is an individual variable insurance contract or IVIC. This term is rarely used and segregated funds are most often simply called segregated or seg funds. Segregated funds are created and sold by life insurance companies. However, not all life insurers offer segregated funds. Those that do go through a process to develop a fund and get the necessary approvals from regulators for the fund. Once all approvals are in place, the fund is open for investment. The date when the fund begins operations is its inception date. Insurers keep their segregated funds separate from other company assets, which is why the funds are called segregated. Insurers manage their segregated funds on an ongoing basis and provide relevant information to potential and existing investors. They are required by law to set aside financial reserves so they can meet their contractual obligations for maturity and death benefit guarantees. People buy segregated funds to benefit from the guarantees they offer for return of capital. This makes segregated funds less risky than mutual funds. Segregated funds are also highly valued because, in the event of the death of the policy owner, the proceeds bypass probate. Probate fees are charged in all provinces except Quebec on assets of a deceased. They can pose a significant charge to an estate. Money is pooled in the fund from the deposits of policy owners. Deposits are made by individuals and groups. Those deposits are invested by the segregated fund manager according to the type of fund that has been created. For instance, the money invested in a bond fund is used by its manager to invest primarily in bonds. Insurers offer many types of segregated funds to match up with the investment objectives of individual investors. Segregated funds are available as investment options for non-registered accounts and registered accounts, such as an RRSP. 1.3.1.1 Advantages and disadvantages of segregated funds. Segregated funds offer some unique advantages compared to other forms of investment. They also have many features in common with other fund-type investments. This overview is an introduction to the reasons people buy segregated funds. It also introduces some of the disadvantages to be taken into consideration regarding segregated funds. Details on these advantages and disadvantages appear in the following chapters of this manual. Unique advantages of segregated funds. Maturity and death benefit guarantees. Ability to reset provided in some contracts. Possible creditor protection. Right to designate a beneficiary and bypass probate. Tax benefit received when capital losses are incurred. Investor protection provided by assurance. Some advantages segregated funds share with other fund investments. Wide variety of funds available. Ease of investment. Vast amount of information available on funds, both before and after purchase. Diversification provided. Professional management provided by the fund manager. Liquidity. Ease of switching from one fund to another. Ease of redemption, making a withdrawal or surrender of the contract. Ability to create an income stream from account value. Available for registered, such as RRSP, and non-registered accounts. Some unique disadvantages of segregated funds that are not shared by other fund investments. Minimum 10-year term to maturity for the maturity guarantee to apply. Often higher fees charged to investors than mutual funds, in the form of the management. Expense ratio, MER. Possible age restrictions on deposits. Some disadvantages segregated funds share with other fund investments. Too many choices of funds and often little differentiation between choices. Sales charges, and ongoing fees charged as the MER. 1.3.1.2 Where and how to buy segregated funds. Segregated funds are sold primarily by life insurance agents and brokers. Some segregated funds are also sold by investment dealers, but those dealers act as agents of the life insurers. The investment dealers are only a sales channel. Investors must be knowledgeable about their segregated fund investment. To ensure they have all necessary details, the agent provides an information folder before or at the time of purchase. The information folder describes the key benefits of the contract. It also provides information about the fund itself, such as fees the investor pays and past performance. When the investor is prepared to make the segregated fund investment, he will complete an application, usually with the agent's assistance. The application is taken by the agent and sent to the insurer. The insurer prepares the segregated fund contract. That contract is a legal document that describes all the terms of agreement between the investor and insurer. It is finalized when the contract is signed and the investor has made a deposit to the account. The contract is an insurance policy, and the investor is the policy owner. 1.3.1.3 Types of segregated funds. Many types of segregated funds are offered. They may be specialized by asset class to include only stocks, or only bonds, or only money market instruments. They also may be based only on real estate, or only on commodities. They may be specialized geographically, for instance to invest only in equities of a specific country, such as Canada, or region, such as North America. Instead of investing in a single asset class, funds may combine asset classes, such as stocks and bonds. Such funds are often called balanced funds. Balanced funds may represent investment in a single country or across regions. Some segregated funds invest in other segregated funds. These are called funds of funds. Other subcategories of funds are also available, but they are based on the main asset classes. A dividend fund, for instance, is based on stocks since dividends can result from owning stocks. Funds offered by different insurers may have very similar names but be quite different. The Canadian Equity Fund offered by XYZ Insurance Co. will not be the same as the Canadian Equity Fund offered by ABC Insurance Co. Each fund holds stocks of companies and the companies may vary fund to fund. Even when the same companies are held in each fund, the percentage of the fund invested in those companies will not be the same. The availability of so many types of funds allows investors to choose from among levels of risk and rates of return. Some funds are riskier than others. Some funds have a higher rate of return than others. Each is designed with specific investor objectives and risk tolerance in mind. 1.3.1.4 Returns and guarantees of segregated funds. The return the segregated fund investor receives is a result of fund performance, increases or decreases in the value of investments in the fund minus fees. The return is reported after fees, if a fund earns 7% and fees are 3%, 4% is the investor's return. The return is stated as a percentage. And it can be a positive number, such as 5%, which shows a profit has been created, or a negative number, such as minus 5%, which shows a loss in the value of the investment. The investor is able to monitor returns for the most recent month, 3 months, year to date, 1 year, 2 years, 3 years, 5 years, 10 years, and since the fund's inception. It is a well-known truth of investing that past results do not indicate future performance. In other words, an investor is only certain of one thing: what has happened. He can never rely on past returns to predict future returns. Investors are able to limit negative returns from their segregated fund investments due to the maturity guarantee and death benefit guarantee. The maturity guarantee states that when the contract matures, the investor will receive a minimum of 75% of the sum he has invested. This guarantee is a minimum return since the amount the investor receives is the greater of the maturity guarantee or the market value of the fund. Example: Lee invests $1,000 in a segregated fund contract with a 75% maturity guarantee. The maturity guarantee is $750, $1,000 times 75%, when his contract matures. Scenario 1. The market value of the contract at maturity is $620. Therefore, Lee receives the maturity guarantee of $750. Scenario 2. The market value of his contract at maturity is $1,440. Therefore, Lee receives the market value of $1,440. There is also a death benefit guarantee provided in segregated fund contracts. If the life insured, called the annuitant, named in the contract dies during the term of the contract, the beneficiary receives a minimum of 75% of the sum invested. If the market value of the contract is higher than the 75% guarantee, the beneficiary receives the market value Example. Jane invests $1,000 in a segregated fund contract with a 75% death benefit guarantee. The death benefit guarantee is $750, $1,000 times 75%. Scenario 1. When Jane dies, the market value of her contract is $700. Therefore, Jane's beneficiary receives the death benefit guarantee of $750. Scenario 2. When Jane dies, the market value of her contract is $910. Therefore, Jane's beneficiary receives the market value of the contract, $910. Together these guarantees limit losses. An investor knows that the maximum amount of loss he could face is the difference between the sum invested and the guarantee amount. Example. Stephen invests $10,000 in a segregated fund with a 75% maturity and death benefit guarantee. He is guaranteed to receive a minimum of $7,500. $10,000 times 75% at maturity or if he dies. The most he can lose over the total period of the contract is $2,500, $10,000 to $7,500. Therefore, if he has the intention of holding the fund until its maturity, he can choose to invest in more risky funds and try to achieve a higher positive return. However, he also knows the most that can be lost. The returns segregated fund investors receive are earned as interest, dividends, foreign income, and capital gains. Investors do not receive the annual return as cash. All returns are reinvested in the fund on an ongoing basis, as they are earned. An investor may choose to hold his segregated fund investment in a non-registered account, a registered account, or both. Investors with non-registered accounts are allocated the return as it is earned in the fund. For instance, capital gains earned in the fund are reported to the investor as capital gains. The investor also receives capital losses, if they occur. The amount reported to the investor as the return must be included in each year's income tax filing. Investors with registered accounts do not report returns for tax purposes every year. They earn returns the same as those with non-registered accounts, but their returns are reinvested in the contract. However, when the time comes to make a withdrawal from their registered contract, investors will find that the sum they receive is taxed at the same rate as income from interest, regardless of how it was earned. In other words, they do not receive the tax benefits of a capital gain or loss, or the dividend tax credit. This is true for all taxable registered accounts. A tax-free savings account is an exception because it is not a taxable account. Example. Robert invests $10,000 in a Canadian equity fund held in his registered retirement savings plan, RRSP, account. Every year the fund grows in value as a result of buying and selling stocks of blue-chip Canadian companies. The growth is all in the form of capital gains earned by selling stocks at a profit. At the end of the contract, Robert's contract is worth $14,324. This sum is now available to him in cash that he can withdraw. If Robert withdraws money from the account, the withdrawal will be taxed as RRSP income, which is taxed at the same rate as income from interest. 1.3.1.5 Risks of investing in segregated funds. While segregated funds are a relatively lower risk investment, at contract maturity an investor still risks the loss of up to 25% of his investment, the difference between the amount invested and the minimum maturity guarantee. Prior to contract maturity, an investor can lose up to the sum invested since the maturity guarantee does not apply. The investor must also be prepared for the minimum 10-year term of the investment. The investor may be unable to take advantage of other investment opportunities during those 10 years. 1.3.1.6 Investor protection. Consumers are protected against insolvency, or bankruptcy, of the insurer that holds their segregated fund contracts through Assuris, a non-profit organization that protects policyholders if their life insurance company fails. This means that if the insurer itself goes bankrupt, the invested money is protected, up to certain limits, by Assuris. The investor is protected against total loss of his principal. The details of the protection Assuris provides are covered later in this manual. Assuris does not provide protection against market losses. Protection against a loss in the value of an investment is provided by the guarantees of certain investments, like the 75% segregated fund maturity guarantee. Non-guaranteed investments can fall to zero value in the market and there is no recourse for the investor. 1.3.2 Annuities. Some investments return the principal invested, plus any profit as a lump sum, to the investor. An annuity is different in that it produces a stream of payments over a period of time. Annuity payments are a combination of the investor's principal and interest paid by the insurer. For this reason, annuities are considered to be a very reliable source of income. They are highly secure, widely available, and protected by Assuris. An annuity is created through a contract between the annuity provider, usually an insurance company, and an investor. The investor's principal is used to fund the contract. The investor names the person who will receive the income payments. This person is called the annuitant. The annuitant may also be known as the annuitant grantee or payee. It is important to carefully read the definitions of the annuity contract, since the wording of the different parties might be different from one contract to another or from one insurer to another. The amount received by the annuitant is called an annuity payment. The annuity payment is based on an annuity rate offered by the insurer, which is largely the prevailing interest rate at the time the investment is made. However, larger sums of principal invested in an annuity receive a higher annuity payment than lower amounts. The annuity payment is also affected by the age and gender of the annuitant. Annuity rates vary between providers. When the annuity payment at the time of purchase is fixed, that payment will be received for the duration of the annuity. It is guaranteed. If interest rates rise, the annuity payment does not increase. Likewise, if interest rates fall, the annuity payment does not decrease. Several types of annuity do not have fixed annuity rates. Their payments are variable. Each guarantees a minimum payment. One form of variable annuity links to investment performance. Its payment will be the minimum payment plus any additional payment as a result of its investment performance. The other form of variable annuity, called an indexed annuity, links to the rate of inflation and increases payments in step with rising inflation. Therefore, its payment is a minimum payment adjusted for any increase in the inflation rate. People buy annuities because of their dependability. They can count on their regular annuity payment. Annuities also relieve the annuitant from any decisions about their investment after initial choices are made. Investors need not worry that they could mismanage their money and possibly experience losses. In effect, the annuity payment is like a pension payment. 1.3.2.1 Advantages and disadvantages of annuities. Some advantages of annuities have already been introduced. The comprehensive list of advantages includes steady income stream. Two variable forms, a variable annuity for investors who hope to increase payments through stock market increases and an indexed annuity for investors who want to increase payments in step with the rising cost of living. Choice of payment frequency, monthly, quarterly, semi-annually, or annually. No need for investment decisions. No need to monitor performance. No worry about outliving one's money when a life annuity or joint and last survivor annuity is purchased. If the annuity is prescribed, less tax may be due in the early years of payment. Investor protection of insurance annuity contracts through Assurance. Available for registered, such as RRSP, and non-registered accounts. Like all investments, annuities have certain disadvantages. They are: lack of flexibility, changes cannot be made to the annuity contract. Interest rate risk, if interest rates rise during the contract continues annuity payments based on the initial, lower annuity rate. Penalties to surrender or withdraw from the contract. Loss of principal for an annuitant with a life annuity if death occurs before all the capital paid to by the annuity has not been paid out in benefits. The amount of money needed to fund an annuity, often not less than $50,000. If the annuity is non-prescribed, there may be a greater tax liability in the early years of payment. Details on these advantages and disadvantages appear in the following chapters of this manual. 1.3.2.2 Where and how to buy annuities. Life insurance companies sell all forms of annuities. Other financial institutions, such as banks, are restricted to sales of term annuities only. Compared to segregated fund investing, a person buying an annuity has very few choices about the investment. He selects the type of annuity, the amount of funding, a payment schedule, and is offered an annuity rate. The annuity can be held in a non-registered or registered account. 1.3.2.3 Types of annuities. The different types of annuities available are the subject of Chapter 3 where they are reviewed in depth. This overview introduces the generic names for what is available. Insurance companies adapt these generic names for marketing purposes. Annuities are fundamentally available in a form that pays an income, called a payout annuity, or a form used for savings, called an accumulation annuity. Payout annuities are the most common. Payout annuities are available in three forms. Term annuity, also known as a term certain annuity, lasts a specific period of time, such as 20 years. Life annuity lasts for the life of the annuitant. When the annuitant dies, the annuity ends. Joint annuity, also known as a joint and last survivor annuity, used by couples so that when one spouse dies, the surviving spouse continues to receive an income from the annuity. When the surviving spouse dies, the annuity ends. 1.3.2.4 Returns and guarantees of annuities. The annuity payment is guaranteed for the duration of the annuity unless the contract is a variable or indexed annuity. As discussed, these forms of annuity provide a minimum guarantee but may supplement that amount with an additional return. 1.3.2.5 Risks of investing in annuities. Interest rate risk is the primary risk of an annuity investment. If interest rates rise after the contract is finalized, the investor cannot benefit from the higher rate. The investor may also be subject to inflation risk. Inflation is the increase in the consumer price index, CPI, which is a measure of the cost of goods and services. The CPI generally sees prices increase and illustrates how goods and services cost more year after year. The annuitant who does not have an indexed annuity that keeps pace with the rate of inflation finds a sure loss of purchasing power over time. As the cost of living goes up, the annuity payment, which is the same amount over its entire contract, buys less and less. The longer the annuity payment is received, the greater the inflation impact. 1.3.2.6 Investor protection. Assurance provides protection for annuity owners and annuitants against the insolvency of life insurance companies. All annuity contracts sold by insurers will be Assurance covered. The details of the protection Assurance provides are covered later in this manual. 1.3.3 Stocks. Stocks are also known as shares or equities. An investor who buys stock in a company is buying ownership in that company. He becomes an owner of a share of the company in proportion to his investment, no matter how small. When investors believe that the fortunes of the company will rise, the value of the investment increases. The opposite is also true. Information about stock value is widely available through websites. Investors need to learn as much as they can about a company in which they intend to invest. Stock is issued in two forms: preferred stock, or shares, and common stock, or shares. Preferred stocks must pay a dividend before the dividend payment is made for common stocks. They also do not usually have voting rights, and therefore a preferred stock owner has no say in the management or operation of the company. Common stock owners have voting rights that allow them to express their wishes in regard to the company at the annual general meeting. Agents who earn their securities license can sell stocks, but agents who sell segregated funds will find stocks are part of their equity, balanced, and growth funds. Those stocks may be Canadian or foreign. Understanding stocks leads to a better understanding of these funds. People buy stocks to participate in their growth in value. Example: $1,000 worth of Apple shares bought in 1997 at $160.40 would be worth $162,589.90 in June 2022. Lower rate of taxation.
Welcome to an introduction to World Financial
to receive
Group.
Dividends. Some buy stocks to take advantage of strategies for derivatives, such as options. The growth or upside of owning a stock is unknowably large, as witnessed by the increase in Apple shares. No one could have predicted in 1997 the development and consumer dominance of the iPhone, iPad, and Mac computers. The loss or downside can be a total loss of invested capital. 1.3.3.1 Advantages and disadvantages of stocks. The main advantage of stock ownership is the ability to benefit from gains in a stock's price. There is no ceiling on how high a stock's price can rise, in theory. Other advantages include high degree of transparency in stock market investing. Stock prices are available for anyone to see through the stock market on which the stock is listed, such as the Toronto Stock Exchange. Dividends. Each stock owner of record as of a certain date receives the dividend, $1 or part dollar amount per share, e.g. $0.50/share, after the dividend has been declared by the company directors. The dividends may benefit the investor by the dividend tax credit. However, many stocks, including those of some of the largest companies, like Amazon, do not pay dividends.
Welcome to an introduction to
Opportunity to attend annual meetings of the corporation. Owners of voting shares can vote on matters of concern, such as a change in management or management salaries. Favorable tax rates for capital gains and capital losses. Capital gains tax is the lowest rate of taxation to be paid on an investment return. A capital loss reduces a taxable capital gain. Available in self-directed registered, such as RRSP, and non-registered accounts. Disadvantages of stock ownership include possibility of loss, even total loss, of principal invested. Possible absence of diversification in the portfolio that exposes the investor to risk. Need to monitor price movement and identify when to buy and sell. Not all companies pay dividends, and there is no guarantee that dividends will be paid. Commissions charged on every trade. Liquidity issues if stocks must be sold at a time when the price is depressed but the investor needs money. No naming of a beneficiary on a non-registered account. No creditor proofing. No ability to rescind a sale. 1.3.3.2 Where and how to buy stocks. Stocks are listed on stock exchanges, such as the Toronto Stock Exchange, TSX. Each listed company is traded under its ticker symbol, which is an abbreviation of the company's name, such as BMO for the Bank of Montreal. Investors have a large number of companies from which to choose. In order to buy stocks, an investor needs an account with an investment dealer that provides trading services, advice and recommendations, with buying and selling provided on a commission basis. Or a discount broker, buying and selling provided on a reduced commission basis. Stock trading is available online in a do-it-yourself approach or through traditional channels, such as an account at a dealer. An application is completed by the investor to satisfy the Know Your Client (KYC) requirement for those who sell stocks. KYC information assures the sales representative that the investment is within the financial capability and risk tolerance of the investor. KYC should be reviewed annually. And if there is a material change in the circumstances of the investor, such as retirement. 1.3.3.3 Returns and guarantees of stocks. Returns on stocks are in the form of capital gains, when stocks are sold at a profit. Dividends, when declared by the board of directors. There is no guarantee that either a capital gain or dividend will be received. Any money invested can be lost. 1.3.3.4 Risks of investing in stocks. Stocks run the spectrum of risk. Blue-chip stocks are the stocks of large, well-known, and well-established companies. For example, in Canada, Canadian National Railway is considered a blue-chip stock. Blue-chip stocks are one of the least risky forms of stock ownership. The most risky are so-called penny stocks. They are stocks valued at less than $5 that are typically illiquid and highly speculative. Penny stocks may include well-known companies, such as Bombardier, in addition to smaller firms that are not household names. An investor in stocks can experience market risk, industry risk, and the risk of loss of principal invested. This loss can be total. Currency risk can diminish returns if an investment is made in foreign currency. Forms of risk are discussed later in this chapter. Derivatives, such as options, exist to help mitigate risk of stock ownership. They are advanced investing strategies and beyond the scope of this manual. 1.3.3.5 Investor protection. Similar to the protection provided by assurance on the life insurance side, investor protection for stock investors is provided by the Canadian Investor Protection Fund, CIPF, in case of investment dealer insolvency. CIPF protects accounts held by its members to specified limits if the dealer becomes insolvent. This does not protect against a decline in the value of the investment, it only covers losses associated with the bankruptcy of a dealer. CIPF member firms are investment dealers that are the members of the Investment Industry Regulatory Organization of Canada, IIROC. It is important to understand that no protection is available for declines in the market price of stocks. If the market price of a stock goes from, say, $100 to $2, investors in that stock have no protection from losses sustained. Their only recourse to try to limit their loss on a declining stock is to sell the stock, if a willing buyer can be found. 1.3.4 Bonds. Stocks are an equity investment. Bonds are a debt investment. This is because bonds represent a debt between a borrower, who is the bond issuer, and a lender, who is the bond investor. Bonds are also called a fixed income security. Many segregated funds focus on bonds or include bonds as part of their portfolio. Therefore, an agent who understands bonds will also have a better understanding of bond funds. Issuers of bonds fall into two broad categories: governments and corporations, both national and international. When an issuer needs money, it issues a bond, which is purchased by investors. The investor, in effect, is lending money to the issuer and the bond is the IOU. The bond market in Canada is huge. In 2020, it was about $1.9 trillion. In 2021, the federal government alone issued $172.5 billion in bonds. 2. Bonds are issued with a fixed maturity date. On that date, the borrower, the issuer, repays the full principal amount to the lender, the investor. The period of time between the issue of the bond and its maturity date is called the term to maturity. Bonds are issued with a wide range of terms to maturity, from 1 year to 30 years. An investor can sell a corporate or government bond before its maturity date to another investor, and An active market exists for buying and selling bonds. This is called the secondary bond market. In return for using the investor's funds for the term of the bond, the issuer makes two promises to the investor. First, during the term to maturity period, the issuer will make regular interest payments to the investor. The interest rate is called the coupon rate of the bond and is typically payable twice a year. Second, the issuer will repay the full face value of the bond to the investor at maturity. Bonds that are issued with a high credit rating can preserve and increase capital as well as provide a predictable stream of payments in the form of interest income. A high credit rating indicates a low chance of the issuer defaulting on payments to investors. 1.3.4.1 Advantages and disadvantages of bonds. Bonds are issued by a wide range of domestic and international business and government entities. Therefore, an investor can choose among credit ratings, issuers, terms to maturity, and coupon rates, i.e., interest rates, to build a diversified portfolio of bonds with the aim of delivering higher returns while reducing overall risk. Managers of bond funds follow such a strategy. Repayment of the face amount and interest payments are guaranteed for government bonds issued by many countries because the issuing government has government revenue at its disposal to meet its obligations. Countries such as Canada, the US, and the nations of the European Union are able to make such guarantees. On the other hand, countries struggling with political or economic uncertainty may represent a risk of default. This could include countries such as Turkey, Egypt, Brazil, or Argentina. A government that could not meet its bond payments as they became due would experience a total loss of international investor confidence. Corporate bond issuers make a commitment to repay their investors for the same reason. They need investor confidence so they will be successful when they need to borrow more money via bonds in the future. However, there is a greater chance payments will not be made for a corporate bond than government bonds since a corporation's fortunes can change quickly, and a corporate issuer might not have the necessary capital at its disposal to repay investors. Breaking the promise to repay investors is taken very seriously. Corporate bonds run the spectrum of risk, and investors who are prepared to take a higher risk are rewarded with higher interest payments from the bond. Bonds are purchased by more sophisticated investors to balance typically large portfolios. Coupon payments made by bonds can also form a regular income stream. Investors are apprised of their risk by the credit rating given by bond rating agencies. Canadian government bonds are rated amongst other bonds with the highest credit ratings, due to the government's ability to pay interest and repay the principal. There is a lack of transparency in the buying process that puts bond investors at a disadvantage. An investor may not necessarily get the best price, and by overpaying, total return is diminished. Also, terminology used to describe prices and yields of bonds can be confusing to average investors. 1.3.4.2 Where and how to buy bonds. Bonds are available through advisors licensed by IIROC and some members of the Mutual Fund Dealers Association, MFDA, who are licensed as limited market dealers. Many financial advisors do not have direct access to bonds because their licenses do not permit them to offer these types of securities. 1.3.4.3 Types of bonds. Bonds are issued by all levels of government in Canada and by Canadian corporations for investors in Canada to buy. Foreign countries and corporations also issue bonds that may be purchased in Canada. Canadian government bonds are issued by the federal, provincial, and municipal governments and are typically denominated in Canadian dollars. Federal government bonds are ranked the highest, provincial bonds lower, and municipal bonds lower still. Foreign bonds are issued by foreign countries in Canada, in Canadian dollars. Euro bonds are issued by a foreign country in its currency for sale in other countries, such as a bond issued by the United States in US dollars for sale in Japan. Government of Canada bonds. The Government of Canada is the largest single issuer of bonds in Canada. It issues bonds in its own name and in the name of federal crown corporations, such as the Farm Credit Canada and the Export Development Corporation. Fully guaranteed by the Government of Canada, the bonds are available for terms from 1 to 30 years, in denominations as low as $5,000. The level of interest is fixed until maturity, and payments are made semi-annually. These bonds can be sold at any time. Provincial bonds. Provincial bonds are issued by the provinces and provincial government agencies. The principal and interest of provincial bonds are guaranteed to be paid when held to maturity. The bonds are also highly liquid and can be easily bought and sold. Municipal bonds. Municipal bonds account for a small percentage of the Canadian bond market. Their ratings vary because their credit quality is dependent on the ability of the municipality to generate tax revenues, among other factors. Like other government bonds, municipal bonds may be sold at market value prior to maturity, and a large secondary market exists for buying and selling such bonds. Corporate bonds. Corporate bonds are issued by companies looking to shore up or expand their operations. The risk associated with a corporate bond is almost totally attributable to the creditworthiness of the company. Foreign bonds. Just as governments and corporations in Canada issue bonds, so too do the governments of other countries and multinational companies. Their creditworthiness is a result of the political and economic stability of the issuer. 1.3.4.4 Returns and guarantees of bonds. A bond issuer pledges to repay the face amount of the bond at maturity and make interim interest payments to the investor. There are many factors that affect the return of a bond. They include interest, coupon, rate, maturity date, credit quality, price, interest rate. Bonds pay interest that can be fixed, floating, or payable at maturity. A fixed interest rate bond is the most common. It pays interest at a rate that is stated as a percentage of the face value of the bond. This interest is usually paid semi-annually. Most bonds pay interest in this way. Example: a bond with a $1,000 face value, bearing coupons with a 3% rate, would pay $30 in interest a year, $1,000 times 3%, $15 on each of 2 payment dates. Maturity. The maturity date of the bond is the future date on which the face value of the bond is repaid to the investor. Maturity dates are often categorized as short-term, medium-term, and long-term. Short-term bonds mature in 3 years or less. Medium-term bonds mature in 3 to 10 years. Long-term bonds mature in 10 years or more. A bond does not have to be held to maturity. It can be sold in the secondary bond market at the current price for that bond. The market price for a bond is not the same as its original face value. Typically, investors in long-term bonds are rewarded with a payment of a higher interest rate as compensation for tying up their principal for a longer period. Credit quality. Bonds are rated based on the issuer's capacity to meet its financial obligations, whether that issuer is a government or a corporation. The highest rated bonds are called investment-grade bonds. They have an AAA rating. On the other end of the risk spectrum are bonds that are most likely to default on repayment. They are called high-yield bonds because they pay a high rate of interest, but are also known by the name junk bonds because of their low rating, typically BB, or lower. The return on investment-grade bonds is much lower than bonds with a higher risk of default, because of the correlation between risk and return. Fundamentally, lower risk investments have a lower rate of return, and higher risk investments have a higher rate of return. Price. The initial investor pays the face value of the bond. This is called PAR. If interest rates change, so does the market price for the bond. When the price rises above face value on the secondary market, the bond is said to be trading at a premium. When the price falls below face value, the bond is said to be trading at a discount. An investor who sells a bond at a higher price than the one initially paid generates a capital gain. On the contrary, an investor who sells a bond at a lower price than the one initially paid realizes a capital loss. 1.3.4.5 Risks of investing in bonds. Bond investors are exposed to a number of risks. These include interest rate risk, reinvestment risk, inflation risk, credit risk, as discussed, and liquidity risk. Currency risk can affect returns on foreign bonds. These forms of risk are discussed later in this chapter. 1.3.4.6 Investor protection. Investor protection for bond investors is similar to that for investors in stocks through the CIPF. The CIPF protects accounts held by its members to specified limits if the dealer becomes insolvent. There is no protection against loss of value. 1.3.5 Savings accounts. When people think of saving money, often the first thing that comes to mind is a savings account at their bank or credit union. Savings accounts offer convenience and, usually, a very low rate of interest. Some accounts are offered as high interest, and these typically have requirements or restrictions in order to receive the better rate. Interest earned in a savings account is automatically deposited to the account. Some people use savings accounts as an investment due to fear of loss of money in other investments and for its accessibility. There is no waiting for funds, a withdrawal can be made at any time. 1.3.5.1 Advantages and disadvantages of savings accounts. A savings account is a source of immediately available cash, with the benefit of interest on the account balance paid at specified periods of time. An account is easy to open and money can be easily deposited and withdrawn. There is often no minimum amount needed to open an account or keep one open. Some financial institutions apply a fee or penalty to withdrawals on savings accounts, especially a high-interest savings account. This acts as an incentive to save money in the account for investing or other purposes. Savings accounts may be advertised with a relatively higher interest rate to attract customers. This promotional rate may not last long. The interest rate that actually applies to the account should be checked periodically. Savers may find the interest rate on their savings account is less than the rate of inflation. Therefore, the money accumulated in savings accounts is subject to inflation risk when the account is used as a long-term investment. The result is that purchasing power is eroded over time. The interest earned in a savings account is taxed at the highest rate charged to investments. This is a disadvantage compared to other investments that pay dividends or receive a capital gain/loss. However, the savings account is a valuable short-term vehicle in which to build savings in even small increments. Those savings can then be redirected into other investments. 1.3.5.2 Types of savings accounts. There are two basic forms of savings accounts, the traditional savings account and the high-interest savings account. The traditional savings account offers a very low rate of interest but sometimes has lower fees and no restrictions on withdrawals. A high-interest savings account offers higher rates of interest that, in some cases, can rival investments such as guaranteed investment certificates, GICs, or money market funds. In exchange for their higher interest rates, there may be a requirement for contributions or a minimum balance, and withdrawal privileges may be restricted. 1.3.5.3 Returns and guarantees of savings accounts. Returns on savings accounts are in the form of interest. Account owners may receive an annual statement from their financial institution with the total amount of interest earned during the year. This must be reported on the investor's annual tax return. Guarantees are based primarily on the strength of Canada's financial institutions, and their ability to immediately cash out an account. 1.3.5.4 Risks of holding savings in a savings account. As mentioned above, holding savings in a savings account exposes the account owner to inflation risk. 1.3.5.5 Investor protection. The Canada Deposit Insurance Corporation, CDIC, is a federal crown corporation that insures savings accounts at member institutions, such as banks, up to $100,000. 1.3.6 Guaranteed Investment Certificates, GICs. GICs are one of the most popular investing options thanks to how easily they can be bought. Absence of fees and their guarantees. People also buy GICs because they are familiar and easily understood. Non-registered GICs can be bought online, further increasing the ease of investing. A GIC is an investment classified as a term deposit. It is based on the investor loaning a sum of money to the institution providing the GIC. The institution guarantees that the investor will receive the principal plus the promised rate of interest at the maturity date of the GIC, except when the GIC is linked to stock market performance. GICs are offered in a variety of terms to maturity. 1.3.6.1 Advantages and disadvantages of GICs. Advantages of GIC investing include guaranteed return of principal and interest as promised. Variety of products available to give investors choice. Available for as little as $500. This helps young investors or investors just starting out who have not yet amassed a more sizable nest egg for investing. Convenient, easy to understand, and easy to buy. Penalties for early redemption are waived if the investor dies during the term to maturity. No out-of-pocket fees. Disadvantages include low rates of return. Return is paid as interest income and taxed accordingly. Subject to probate fees on death, unlike their insurance equivalent called accumulation annuities. Interest rate risk. Inflation risk. Significant penalties charged to the investor who needs access to the funds in the GIC prior to its maturity date. 1.3.6.2 Where and how to buy GICs. GICs can be purchased from financial institutions including banks and trust companies, credit unions, caisses populaires, 3. Insurance companies, investment dealers, specialized GIC deposit brokers. An application is completed, supplemented with a proof of deposit. 1.3.6.3 Types of GICs. Different types of GICs have distinctive characteristics. The fixed interest GIC is the GIC that most people think of when GICs are offered. Call these plain vanilla GICs. Features that are added to the plain vanilla product will carry additional costs to the investor, such as a lower interest rate. Fixed interest GICs. The return on a fixed interest GIC is a specific guaranteed interest rate. Interest payment options include simple interest that is paid annually and interest that compounds annually and is paid at maturity. Even if the interest is not paid in any one year to the investor, it needs to be declared for income tax purposes. Cashable/redeemable GICs. A cashable or redeemable GIC allows the money deposited to the GIC to be received at a date earlier than the maturity date. However, the cost of this feature is that interest rates are lower than those offered on non-redeemable GICs. Escalating GICs. An escalating GIC increases interest rates on its anniversary date. A variation on this form of GIC allows the investor to cash out some or all of the funds on each anniversary date or a specified number of days thereafter. Variable interest GICs. If general interest rates increase over the term of an investment, so does the interest rate of the GIC. Therefore, interest rate risk is lessened. Market-linked GICs. This form of GIC links a portion of its return to the performance of a specified equity market index, such as the S&P/TSX Composite Index. In most cases, market-linked GICs are not cashable before their maturity date. Returns are capped, and, in some cases, investors receive only a portion of the investment returns generated by the actual performance of the equity markets. Foreign currency GICs. A foreign currency GIC is issued in a foreign currency, such as US dollars, and pays fixed interest. It is purchased by investors who believe the Canadian dollar will fall in value against the currency in which the GIC is issued. Therefore, on maturity of the GIC, the foreign currency received is worth more Canadian dollars. Insurance GICs. The accumulation annuity is also known as an insurance GIC. Available exclusively from insurers. This form of GIC offers benefits based on its issue as an insurance contract. These benefits include bypass of probate and creditor protection. These annuities are discussed in detail later in the manual. 1.3.6.4 Returns and guarantees on GICs. GICs guarantee return of principal and interest at the stated maturity date. Their returns are in the form of interest. 1.3.6.5 Risks of investing in GICs. The GIC investor faces interest rate risk and inflation risk. These risks are described in full later in this chapter. 1.3.6.6 Investor protection. The Canada Deposit Insurance Corporation, CDIC, insures Canadian dollar GICs, held at a CDIC member institution, up to $100,000, in each deposit category. Therefore, up to $100,000 in coverage is provided for a GIC that is separate from coverage for an RRSP, RRIF, TFSA, etc. Insurance GICs, accumulation annuities, are protected by Assurus, the organization that provides investor protection to Canadian life insurance policy owners. 1.3.7 Mutual funds. Mutual funds are created on the basis of investors' money being pooled into a fund that is owned and managed by a mutual fund company or financial institution. Segregated funds are created on the same basis but are owned and managed by an insurer. Most banks, credit unions, and mutual fund companies offer conventional mutual funds that are known as open-end funds. A mutual fund may be structured as an open-end fund or a closed-end fund. An open-end mutual fund distributes units in the fund to investors proportional to the amount they have invested. A closed-end mutual fund issues a fixed number of shares. This type of mutual fund will not be covered in this manual. New open-end mutual fund units are continually issued as investors deposit money into the fund, while units are eliminated, redeemed, when investors decide to leave the fund. There are thousands of mutual funds available for investment. The challenge for the investor and his financial advisor is to narrow down the choice to one fund, or perhaps several funds, that will be the most suitable for the investor's investment objectives. People buy mutual funds because they are often sold by advisors in financial institutions as an alternative to GICs that offer greater growth potential. While this may be true, matching one or two mutual funds, of the thousands of funds available, to the needs and limitations of the investor takes knowledge, skill, and patience. The advisor should explore the characteristics of funds to ensure suitability to client needs. The client should understand how mutual funds make money, what makes them go up in value, the total fees to buy, hold, and sell their funds, the risks of their investment, how easily their investment could be redeemed as cash. Agents sell mutual funds when they earn their securities license or mutual funds license. These agents may be called dual licensed. Investors in a mutual fund pay fees to participate in the fund. There are three types of fees. The management expense ratio, MER, which is expressed as a percentage of the fund's assets. It is an annual fee charged by the fund to cover compensation paid to the professional managers of the fund, to pay trailing commissions to advisors, operating expenses of the fund, and taxes. The managers make the decisions about what to invest in, when to buy and sell holdings within the fund, the allocation and diversification of holdings, and many other factors that affect returns. The MER is deducted from fund performance before the performance is reported to investors. As of June 1, 2022, some mutual funder dealers eliminated the trailing fee charge. The trading expense ratio, TER, which measures the trading costs of the fund. It is also expressed as a percentage of assets. A higher TER is evidence of more frequent buying and selling of holdings by the portfolio manager. It is deducted from fund performance before performance is reported to investors. The TER is also charged annually. A sales charge, also called a load, that may be applied against the amount of investment at the time units are purchased or redeemed. When applied at the outset of the investment, it is called a front-end load. Alternatively, the load may be applied when units of the fund are sold. It is then referred to as a back-end load or deferred sales charge, DSC. A DSC declines over a period of years until it is eliminated. As of June 1, 2022, all provinces and territories will prohibit fund organizations from charging a DSC on new sales, but redemption schedules for sales prior to the ban will run their course in Ontario. This means clients could face DSCs until 2028 or 2029. Some funds are sold on a low-load basis, in which there is a lower fee charged at redemption. Funds are also available with no loads. A standardized risk classification methodology is used for conventional mutual funds and exchange-traded funds, ETFs. This methodology is based on using standard deviation as the risk indicator to determine a mutual fund's investment risk. The standard deviation equates to 1 of 5 levels of investment risk: low, low to medium, medium, medium to high, and high. This approach provides consistency across all fund risk assessments and makes it easier for investors to compare the investment risk of different mutual funds. Example: using the standardized risk classification methodology, New Global Balanced Fund has a standard deviation of 10. This means the fund has a low to medium investment risk level. George's is seeking a fund investment with this level of risk. Therefore, New Global Balanced Fund could be suitable for George's based on the fund's risk level and George's risk tolerance. 1.3.7.1 Advantages and disadvantages of mutual funds. Mutual funds offer many of the same advantages as segregated funds, including wide variety of funds available, ease of investment, vast amount of information available on funds both before and after purchase, diversification, small minimum purchase required. Some funds allow an initial investment of $500 with minimum deposits of $25. Professional management, liquidity, ease of switching from one fund to another, ease of redeeming units. Mutual funds provide the advantage of a variety of withdrawal plans for the account owner. These are called systematic withdrawal plans. The investor may, of course, redeem his investment as a lump sum whenever he chooses, but may also redeem a specified amount per withdrawal to spread out redemptions over a period of time. Disclosure to clients on fees is required by Client Relationship Management 2, CRM2. CRM2 requires mutual funds to provide additional written communication to clients, an annual report on costs and fees, and an annual report on performance. This disclosure is intended to ensure investors thoroughly and accurately understand their fund investment. Some of the disadvantages of which investors should be aware are: mutual funds are not intended to be a short-term investment, and investors must be prepared to hold units for a long period of time to achieve desired returns. No protection against losses, like that offered by the guarantees of a segregated fund. Tax complexities arise in non-registered accounts that require investors to monitor fund activity. The fees, such as MER, can erode returns significantly over time. 1.3.7.2 Where and how to buy mutual funds. Mutual funds are offered for sale through banks, credit unions, caisses populaires, insurance companies, investment dealers, and mutual fund companies. They can also be purchased online. With some institutions, there are 2 steps that must be completed prior to purchase. First, a new account application form is completed in which the investor specifies the fund in which He will invest, and know your client, KYC, information is gathered by the sales representative. The KYC information is used by the advisor to align investor characteristics, such as risk tolerance, with the proposed investment. Next, disclosure requirements must be satisfied to ensure that the investor understands the details of the fund he is contemplating purchasing. This requirement is met by the mandatory delivery of the fund facts to the investor, and providing him with an option to request a simplified prospectus of the fund in an annual information form, AIF. Fund facts outlines the potential benefits, risks, and costs of investing in a mutual fund, in language investors can easily understand, at a time that is relevant to their investment decision. They are intended to confirm suitability for the investor, both at the time of purchase and on an ongoing basis. Mutual fund companies are required to prepare and file a fund facts for each class or series of each of their mutual funds and to post the fund facts on their website. They are required to deliver the fund facts to the investor before he buys. A simplified prospectus of a fund is a document that is filed with the appropriate regulator that provides full disclosure of material facts that have, or might have, an impact on the market value of the fund. The AIF supplements the information in the simplified prospectus with information that may be of assistance or interest to some investors. When the purchase is made, the fund units are bought at their market value. When the investment is redeemed, the units are sold at their market value. Money market funds are an exception. They do not have a market value. Instead, their units are redeemed at a fixed value. 1.3.7.3 Types of mutual funds. The types of mutual funds available parallel the types of segregated funds available. The Canadian Investment Funds Standards Committee, CIFSC, categorizes funds into 5 broad asset classes. Cash, including funds in the money market. Fixed income. Equity. Commodity. Other. Funds are further assigned a geographical classification or identified as a developed or emerging market. A detailed description of the fund types is provided in Chapter 2. 1.3.7.4 Returns and guarantees of mutual funds. There are no guarantees for the mutual fund investor. The return for a mutual fund is determined based on its net asset value, NAV, per unit and any distributions made by the fund. The NAV is the total net asset value of the fund divided by the number of outstanding units. Distributions are a combination of earnings generated by securities within the fund and capital gains resulting from buying and selling those securities. Non-registered account owners may receive their distributions in cash or reinvest them in the fund. Example: if the units of a fund increase in value from a total of $1,000 to $1,200 over the course of a year due to distributions, the investment is worth $1,200 at year-end. The return is calculated by the investor's year-end value minus initial investment, $1,200 to $1,000, to equal the investor's profit of $200. That profit is then divided by the initial investment, $200 divided by $1,000, to show the return, which is 20%. The distributions, or the profit, are automatically reinvested in the fund. An investor who wants to find the best long-term performer in a class should compare returns for at least the last 5 years between similar funds. In other words, the results of a bond fund must be compared only with the results of a similar bond fund. However, if the investor is simply motivated to find the best return, he could compare 5-year results between different asset classes. For example, he might compare a bond fund with an equity fund. 1.3.7.5 Risks of investing in mutual funds. There are many risks of mutual fund investing, and some risks are particular to the asset class to which the fund belongs. Cash-based funds face interest rate and inflation risk. Equity-based funds face market risk and industry risk. Fixed income funds face interest rate risk. Currency risk can be experienced by funds in which there is foreign investment. These forms of risk will be described later in this chapter. 1.3.7.6 Investor Protection. There are two investor protection funds available to mutual fund investors. Both can be accessed. In the case of dealer insolvency, they do not cover market losses. The protection is provided by the Canadian Investor Protection Fund, CIPF, mentioned earlier, and the Investor Protection Corporation, IPC, of the Mutual Fund Dealers Association, MFDA, that insures MFDA members. MFDA members are firms that distribute Canadian mutual funds. The maximum amount of coverage is $1 million for each general account. There is no protection for market losses. 1.3.8 Exchange-Traded Funds, ETFs. Exchange-Traded Funds, ETFs, are a type of pooled investment fund in which investors receive shares in the type of fund in which they invest. Mutual funds and segregated funds also pool investor deposits but issue units instead of shares. People who buy ETFs may be slightly more sophisticated investors than those who buy GICs or mutual funds because ETFs are bought and sold on a stock exchange, and therefore the investor needs a brokerage account at an online vendor or traditional broker. Investors are motivated by the lower fees of ETFs compared to mutual funds. ETFs are the investment product sold by robo-advisors, such as Wealthsimple. Robo-advisors are online investment advisors who use software to automate many tasks that were traditionally performed by portfolio managers. Clients complete an online questionnaire to specify their goals, time horizon, and risk tolerance. The results of that questionnaire determine the best ETF approach. The software of the firm continually monitors the investor's account and rebalances the account automatically to maintain the correct asset mix. This hands-off approach translates into lower fees for the investor who does not want access to personal assistance. ETFs are available in an indexed form and an actively managed form through traditional investment dealers who act as account managers. They guide investors in their choices. The indexed form mimics the returns of an underlying index, such as a stock market index. Indexes exist for many asset categories, for instance equities on the S&P/TSX Composite Index, bonds, commodities, or real estate in Canada and abroad. The actively managed form sees the manager choosing investments for their contribution to a stated investment objective, such as capital growth. There is typically a cost to ETF investors when they buy and sell their shares. This comes in the form of a sales commission, which is similar to the commission charged when an investor trades stocks. Although some ETFs are available without a commission, firms that offer commission-free ETFs will compensate for the absence of commissions in other ways. They may impose the purchase of a specified number of units or a dollar value per trade or require the investor to assign up to their online investing platform. Like mutual funds, a MER is also charged against ETF shares, however the MER is significantly lower than the MER of mutual funds or segregated funds. Also, like mutual funds, a trading expense ratio, TER, is charged. Active ETFs incur the highest TERs because more trading results in a higher total trading cost. Investors may also be charged a trailer fee by the financial advisor managing the ETF on their behalf. 1.3.8.1 Advantages and disadvantages of ETFs. Some of the advantages of ETFs include diversification, convenience of trading like stocks, high degree of transparency with holdings disclosed daily, lower MER than mutual funds and segregated funds, no sales load, professional management, ability to react rapidly to market developments and speculation on short-term price movements, ability for advanced trading transactions such as limit, stop-loss, margin, and short sale orders, options, and sector rotation, exposure to commodities provided to small investors. Some of the disadvantages of ETFs include: a commission is usually charged on buy and sell orders. Low liquidity for ETFs that are not frequently traded or not traded in high volumes. Fees include both MER and TER. Complexity of the investment. The litmus test for investment suitability is the ability of the investor to describe how his money is invested, how growth is achieved, and the conditions under which his principal and returns are received. If an investor is unable to answer these questions about an ETF, then it may not be suitable for him. 1.3.8.2 Where and how to buy ETFs. ETFs are currently sold by ETF Facts. This document contains all the information the investor needs to base his buying decision on, and provides consistent disclosure about the investment, like Fund Facts does for mutual funds. However, since ETFs are traded on an exchange, additional content addresses trading and pricing characteristics. A prospectus is available to investors upon request. To make an ETF investment, the investor either opens an account with a securities firm, discount broker, robo-advisor, or uses an existing investment account. If a discount broker is used, the applicant must find the correct exchange and stock ticker symbol for the desired ETF. 1.3.8.3 Types of ETFs. ETFs are available to track currencies, industries, commodities, style, such as growth, value or market capitalization, bonds, dividends, or real estate in Canada and abroad. Still other, more exotic ETFs are available. For example, inverse ETFs move in opposite direction of an associated exchange index or indexes. Inverse financial sector ETFs, for example, profit when the financial sector declines. Volatility-linked ETFs are bets for or against volatility in the stock market. Index-based ETFs track their target index in one of two ways. A replicate index-based ETF holds every security in the target index because it invests 100% of its assets proportionately in all the securities in the target index. A sample index-based ETF does not hold every security in the target index. Instead, the sponsor chooses a representative sample of securities in the target index in which to invest. Actively managed ETFs do not mirror an underlying index. They have a benchmark index, used as a standard to monitor performance. Managers, however, have the ability to change sector allocations, time trades, or deviate from the index as they see fit. Actively managed ETFs must disclose the identities and weightings of the component securities and other assets held by the ETF each business day on their publicly available websites. This provides a level of transparency unique among fund investments. 1.3.8.4 Returns and guarantees of ETFs. There are no guarantees for ETFs. Investors buy and sell shares at market price, and this price changes throughout the trading day. Valuation occurs daily. The performance of an ETF may not exactly mirror the performance of its underlying index. Sometimes the holdings in the ETF are not exactly the same as its underlying index or in exactly the same proportion. This can account for a difference in return between the actual index and the ETF. Distributions are received by investors in the form they are earned, interest, dividends, or capital gains. Cash distributions are paid monthly, quarterly, semi-annually or annually. Capital gains are distributed in December. 1.3.8.5 Risks of investing in ETFs. ETF risk is classified in the same manner as mutual funds, and is expressed as low, low to medium, medium, medium to high, and high. These levels are based on a range of standard deviation, which is a formula measuring returns. It demonstrates that the highest risk is experienced in those funds with the highest standard deviation. ETF risk is a result of the index or industry that the ETF emulates, or where the underlying index is based. Therefore, they have market risk and may have industry risk and currency risk. ETFs may also experience liquidity risk if the fund is not broadly based. ETFs that have narrow categories or are country-specific may be thinly traded. Severe economic conditions could dry up trading for such ETFs. 1.3.8.6 Investor Protection. The CIPF protects accounts held by its members up to specified limits if the dealer becomes insolvent. There is no protection against market loss. 1.3.9 Real estate. Real estate for investment purposes is not the purchase of the principal residence of the investor or other property used strictly for personal use. Investment real estate includes residential, commercial, and industrial properties that the investor buys and, in turn, rents or leases to occupants. An investment in real estate offers the investor the opportunity to gain from an increase in the market value of the property, and to earn rental income. Equity can grow rapidly if rental income is applied against an outstanding mortgage. 1.3.9.1 Advantages and disadvantages of real estate. Investing in real estate adds diversification to an investor's portfolio of investments. Real estate offers the following advantages to an investor. Potential to earn a steady rental income. Potential to earn a capital gain on the sale of the income property and benefit from the tax advantages accorded to capital gains thanks to the capital gains exemption. Potential to see an increase in property value due to general real estate market conditions or due to improvements in the property that the investor makes. Easily purchased investment. Physical asset that can be used as collateral to secure borrowing. The disadvantages of investing in real estate include need to fund the down payment for the land or property. This can be a significant sum depending on the value of the real estate being purchased. Need of the investor to provide evidence of financial stability and strength. He must be able to prove to the holder of a mortgage on the property that he can personally make mortgage payments if rental income dries up. Commissions charged on real estate sales by sales agents are high and greatly reduce the sale proceeds. Other fees, such as a land transfer tax, may also be charged. Value is subject to market conditions. Just as prices may increase, they may also decrease. Obligations of becoming a landlord. Real estate investor landlords have many legal requirements and obligations to their tenants. Ongoing expenses in the form of property maintenance, property tax, and landlord insurance. The property must be kept up to preserve the investment, and to meet obligations to renters. Tax must be paid to local authorities based on the value of the property, and insurance will be required to protect against claims that result from premises liability, fire, smoke, water damage, and vandalism. These expenses must be tracked over the entire period of ownership to reduce the capital gain on the property. Government speculation tax. Jurisdictions have implemented a tax on foreign nationals in unoccupied residential properties. 1.3.9.2 Types of investment real estate. Real estate investment properties include residential, commercial, and industrial properties. Residential properties include all forms of homes that people rent or lease in which to live. They include condominiums, apartment buildings, and single or multi-family homes. Commercial properties are those used mainly for service businesses, such as a restaurant or office building. Industrial properties tend to be large buildings and facilities in which manufacturing and related businesses generally operate. Investment real estate also includes the ownership of land. This is property that is undeveloped, but expected to be developed at a future date. 1.3.9.3 Returns and guarantees of real estate. There are no guarantees provided to real estate investors. Returns are in the form of rental income, which is taxed like interest income, but certain expenses are allowed to be deducted from gross rental income. A capital gain, or capital loss, may be generated if the property increases in market value, or loses market value, at the time of sale. 1.3.9.4 Risks of investing in real estate. Real estate poses some of the greatest investment liquidity risk. An investor who needs the money invested in real estate must hope that a likely buyer can be quickly and easily found. Otherwise, he has little option but to start reducing the price of the property until the price has dropped to a point at which he will attract a buyer. Market risk can be experienced in the real estate market if prices fall where the property is located. If buyers lose their appetite for certain types of properties or if the entire market falls. A real estate investor may experience interest rate risk on the mortgage for the property. If interest rates increase during the term of the mortgage, such as 5 years, the higher interest rate will be charged at the time of renewal. This could mean a higher mortgage cost, which might not be able to be offset by charging higher rent. Interest rate risk is detailed further in this text. 1.3.9.5 Investor Protection. There is no investor protection for real estate investors. January 3, 10 Canada Premium Bonds, CPBs, and Canada Savings Bonds, CSBs. Canada Premium Bonds, CPBs, and Canada Savings Bonds, CSBs, were two well-known types of savings bonds offered by the Government of Canada to residents. Their sales were discontinued as of November 2017, and in 2021, all remaining outstanding CSBs reached maturity. These bonds are only of historical interest. January 3, 11 Cryptocurrency. Cryptocurrency, like Bitcoin, and also called cryptos and altcoins, is used both as a form of payment and for speculative investment. It is a digital currency in which crypto tokens are used by participants to transfer value. Cryptocurrency is bought and sold through online exchanges. There are hundreds of exchanges. And as of March 2022, 18,465 cryptocurrencies, with new currencies steadily being introduced. Cryptocurrency can also be earned through a process called mining, which requires an enormous amount of computer power and technology. People buy cryptocurrency as a means of buying goods without an audit trail or regulations. It is therefore an ideal medium of exchange for criminal activity, including money laundering and terrorist financing. Transactions occur instantly. The cryptocurrency exchanges charge a fee on sales transactions. Investors also buy cryptocurrency simply to hold and wait for its value to increase. At the start of 2022, the market value of all cryptocurrencies was $1.6 trillion. In November 2021, it had been $2.9 trillion. In June 2022, it was $971.6 billion, a decrease of almost 14% from the previous day. Such swings in value are the norm, not the exception. Bitcoin reached $1 in value in 2011. In June 2022 it was CDN 3198.20. Its all-time high was CDN 88,497.17.5. Some cryptocurrencies are available for purchase with dollars while others require cryptocurrency. The buyer creates an account on an exchange, and then transfers his coins to a wallet that is specific to the buyer. An online wallet is called a hot wallet, and may be susceptible to hacking and theft. A cold wallet is a physical device like a USB drive. It is more secure than a hot wallet. Transfers are recorded in a public ledger. Investing in cryptocurrency is extremely risky. Prices rise and fall dramatically. Most advisors would conclude that an investor be prepared for complete loss of a cryptocurrency investment. January 3, 12 Group Plans. Groups that offer savings and investment plans to their members include employers, associations, and fraternal organizations. Group plans are most often associated with employers. They participate as the subscriber or administrator of the plan. The subscriber/administrator contracts with a group plan provider, such as an insurer, in order to offer a plan to employees. The employees participate in the subscriber's plan to accumulate savings for retirement. Participation by the employee may be mandatory or optional. A group plan satisfies a very distinct objective for each of its two participants. An employer uses a plan perhaps together with other company benefits, to attract and retain employees. A potential employee sees the group plan as a point of differentiation when weighing up a salary plus benefits package offered by the employer during hiring. Then, as an employee, the plan is a way to save money for retirement. There are 6 fundamental types of group savings plans, and their features and characteristics are described later in this manual. 1.3.12.1 Advantages and disadvantages of group plans. The advantages or disadvantages of a group plan depend on how well each type of plan available meets the objectives of the participants, and this depends partly on the type of plan adopted. These details are provided later in this manual. 1.3.12.2 Where and how to buy a group plan. Group plans are available from many providers. Insurance companies are one source. The group administrator coordinates a plan between the plan provider and plan members. The group administrator enrolls new members, removes those who are no longer employees, ensures contributions are met, processes withdrawal requests, communicates plan details to members and management, ensures each member receives an annual pension plan statement. Establishing a group plan requires the plan owner, which is usually an employer, to choose a type of plan that is suitable for its employees and the financial capacity of the firm. 1.3.12.3 Types of group plans. Group plans available for savings and investment purposes include the following. Defined Benefit Pension Plan, DBPP. A DBPP pays a specified pension at retirement to plan members. Defined Contribution Pension Plan, DCPP. A DCPP, also known as a money purchase plan, does not pay a specified pension at retirement to plan members. Group Registered Retirement Savings Plan, GRRSP. The sum available at retirement depends on earned income on which the RRSP contribution limit is based. Deferred Profit Sharing Plan, DPSP. A DPSP shares a portion of company profits earned by the employer with employees. Tax-Free Savings Account, TFSA. A TFSA allows an investor to earn tax-free investment income. The sum available depends on the amount saved and how it is invested. Pooled Registered Pension Plan, PRPP6. A PRPP is a retirement savings plan for small business employees and the self-employed, in which the sum available at retirement is not specified in advance. 1.3.12.4 Returns and guarantees of group plans. As a plan member, and perhaps an employer, make contributions to a group plan, that money is prudently invested so that, when the time comes, the member will receive the proceeds of his plan. Regardless of how invested contributions grow over the period they are in a plan, all withdrawals from registered plans are taxed as interest income. The only group pension plan that offers a guaranteed income on retirement is a DBPP. However, DBPPs can only guarantee the expected retirement income to members if their plans are fully funded. A fully funded plan is one in which the sponsor, example employer, has made all the contributions to the plan for all plan members according to its actuarial obligation. Some employers have pension shortfalls because they have not made the required contributions. This means their pension liabilities are greater than their ability to pay. Pensioners could receive less than the amount of pension promised to them. 1.3.12.5 Risks in offering a group plan. The employer commits financially to make contributions and to pay the cost of administration. If business conditions change and company profitability suffers, meeting corporate commitments to pension contributions may be difficult. This could result in underfunded pension plans. 1.3.12.6 Risks in participating in a group plan. If a plan member, example an employee, is responsible for making his own investment decisions, as he would in a DCPP or a GRRSP, then he faces the risks that come with investing, such as interest rate risk, inflation risk, and market risk. Also, the savings in a group plan are locked in until retirement. This means that withdrawals cannot be made before retirement. All provinces provide unlocking provisions in the event of financial hardship or other proven need, but the retiree must prove that the funds are needed. This is a good reason for an individual who is enrolled in a locked-in plan to also save in a plan that can provide immediate access to funds, such as an RRSP or a TFSA. 1.3.12.7 Plan Member Protection. Pensions are administered provincially/territorially through the Financial Institutions Commission or ministry responsible for the Pension Benefits Act of the jurisdiction. The rights and benefits of plan members are protected through the acts. Some safeguards exist against corporate insolvency and inability to meet pension promises through the agencies that administer pension legislation in their province or territory. However, there are companies that have failed to meet their pension obligation and have left their members with nothing. Their savings are gone. Some jurisdictions provide a guaranteed minimum income to plan beneficiaries who experience shortfalls due to underfunding. For example, in Ontario, the Pension Benefits Guarantee Fund insures pensions up to $1,500/month.7. 1.4 Risks of investing. There are many risks of investing. Some can be controlled by the individual investor and some cannot. 1.4.1 Economy as a whole. Economic risk, which also includes political and legal risk, is the possibility that an investment will be affected by macroeconomic factors. Such factors include a change in government regulation or political upheaval that intervenes in all aspects of a society. Pandemic risk must be considered part of economic risk due to the societal impact caused by a worldwide epidemic and its aftermath. As 2020 and 2021 proved, the global economy may be affected by a pandemic. Economic risk cannot be managed by an individual investor. It is very difficult to predict and can have a significant impact on investment returns. 1.4.2 Equity risk. Anyone who invests in stocks listed on the stock market, directly or indirectly through equity funds, faces equity risk. Stock prices are established in the market and represented by stock trading exchanges such as the S&P/TSX Composite Index. The market price of all stocks is in a constant state of flux, rising and falling according to supply and demand. Equity risk is the risk of loss because the stock price falls. 1.4.3 Inflation risk. Inflation risk is also known as purchasing power risk. Inflation is the increase in the cost of goods and services as measured by the Consumer Price Index, CPI. Inflation affects everyone. For people in their working years, an inflation rate may exceed wage increases. This is true for many in 2022. The result is that people cannot buy the same services or products as they could previously. When demand for goods decreases, companies reduce their output. Doing so increases unemployment since less employees are required to produce lesser goods. Meanwhile, fewer goods often drives up their prices due to the principle of supply and demand. Inflation truly is a vicious cycle. It is very important for an agent to bear inflation risk in mind in recommendations, especially when dealing with younger clients who anticipate many years before retirement or their death. The longer the time horizon for investing, the greater the impact of inflation can be. Also, those living on fixed incomes, such as retirees, strongly experience inflation risk. Although many private pensions from employers have a cost of living increase embedded in their plans, most retirees do not enjoy the benefits of a private pension. Their retirement income is sourced primarily from withdrawals from savings and investments. Inflation is one of the factors in calculating the real return of an investment. Investment returns become more accurate when inflation is factored in. Some investments' rate of return is lower than the rate of inflation. When this happens, the investor experiences a return that in turn causes a loss of purchasing power. That means he must spend more to buy an equal amount of goods and services in the future. Prices have increased but his income is less than the cost of the goods he needs to buy. The investor must face some hard decisions that can include taking out larger withdrawals, and thereby depleting his account faster than anticipated, finding a less expensive alternative, buying less, or going without. Inflation is made more serious because it compounds year over year. Prices are inflated on inflated prices and so on. This is why long-term investments with low returns are particularly vulnerable to inflation risk. Investments with low returns or returns that are tied to a specified rate of interest are affected by inflation. These include investments such as cash in savings accounts, GICs, bonds, and money market funds. Segregated funds that experience inflation risk are money market funds, and those invested in bonds. Annuities also experience inflation risk when they are issued with a low interest rate. Equities are not immune from inflation risk. Fear of inflation causes stock market volatility, which in turn affects equity funds and equity investors. Example: assume that the average rate of return on a 1-year guaranteed investment certificate, GIC, on sale today is 2.2%. The inflation rate as of May 2022 is 6.7%. Therefore, if we assume the inflation rate will be the same for the next year, the real rate of return on the GIC is 4.5%, 2.2%, 6.7%. The GIC is losing significant purchasing power. 1.4.4 Interest rate risk. Interest rate risk is experienced when an investment is locked in at a low interest rate. The investor will not be able to take advantage of higher interest rates if interest rates begin to climb. Interest rate risk is experienced with inflation risk. In mid-2022, interest rate risk is a reason for falling residential real estate prices because buyers cannot afford large mortgages at higher interest rates. Banks and other mortgage providers stress test potential buyers before offering a mortgage to ensure the buyer can financially tolerate higher interest rates. Buyers are failing the stress test and simply finding the larger mortgages more than they wish to spend. Less demand for housing results in falling prices and can slow the construction of new homes. This can have a major ripple effect through the economy. Example: assume that the interest earned on a 3-year GIC is 3%. The interest rate that applies to GICs increases to 3.4% 9 months after the GIC is purchased. The investor cannot benefit from the rise in interest rates. He is tied to the lower rate for the balance of the term. Interest rate risk also occurs in bond pricing. As interest rates rise, bond prices decline, and vice versa. Therefore, the market value of a bond is less in a rising interest rate environment. Interest rate risk is inherent in all investments that pay fixed rates of interest. This includes GICs, accumulation annuities, payout annuities, savings accounts, and bonds. 1.4.5 Market risk. Market risk is the risk that the total financial market will decline due to uncontrollable events. Diversification does not provide protection against market risk since many or all asset classes could be negatively affected. Events that can precipitate market risk include an economic event or a recession, pandemic, a major natural disaster, or a terrorist attack. Example 1. The financial crisis that began in 2007 was an example of how an economic event gave rise to market risk. The events that started that year and continued through to the end of 2008 caused all asset classes to decline. Massive government intervention was needed to prevent a total economic collapse. In 2007, many U.S. homeowners owed more on mortgages than their properties were worth. This led to many foreclosures on residential real estate. In the U.S., people simply walked away from their houses and mortgages, leaving the financial institutions holding those mortgages without incoming mortgage payments. This event became known as the subprime mortgage crisis. Real estate as an asset class was seriously negatively impacted. The loss of mortgage payments by financial institutions also affected the entire financial system because many investment dealers and banks had created financial products based on subprime mortgages. In September 2008, the U.S. Congress rejected a $700 billion Wall Street financial rescue package for the financial services firms affected by the subprime mortgage crisis. This sent the Dow Jones Industrial Average down 778 points. Thus, equities were affected as an asset class. Most investors felt some degree of impact from this crisis. Example 2. When the coronavirus pandemic started seriously impacting North America in March 2020, creating fear and uncertainty, there were negative effects on both the equity and bond markets. On March 12, 2020, the S&P/TSX Composite Index had its biggest single-day decline since 1940, losing 12.34%, a loss of 1,761.64 points. The bond market had already plummeted during February and early March, reaching its low point on March 9. Losses were not restricted to the North American markets. Markets around the world all reacted to the uncertainty of the pandemic with huge declines. These losses turned out to be temporary, and in April 2022, the TSX reached an all-time high. By May 2022, the market had reversed and had lost over 5% for the year due to increasing interest rates, war in Ukraine, and continuing coronavirus lockdowns in China. Investors do not like uncertainty, and national and international events of the year showed a high degree of uncertainty as to what happens next for the price and availability of products, including oil. Real estate in 2021 continued to show ever-increasing market prices in many locations, although as interest rates started to climb in 2022, prices started to fall. This series of events brought on by the pandemic illustrates how unknown and unpredictable forces can control markets and how investors can experience market risk. 1.4.6 Liquidity risk. Liquidity risk is the risk that an investment cannot be easily and quickly converted into cash. It also describes the risk that an investment cannot be sold without affecting its value. Real estate is a prime example of an asset with liquidity risk. Annuities also have liquidity risk. Some annuities can be surrendered, but a withdrawal penalty charged by the insurance company, along with market value adjustments, will reduce the value of the investment. 1.4.7 Foreign exchange risk. Foreign exchange risk, also known as currency risk, is the risk that there is a change in price of one currency against another. It is experienced by investors or companies that invest or have assets or business operations in foreign countries. Investment funds that invest in specific foreign geographic locations, such as the U.S., face this form of risk. 1.4.8 Credit risk. Credit risk, also known as default risk, is the risk that a borrower will fail to repay a loan or other financial obligation. It is particularly relevant to corporate bond issuers. Borrowers with the highest credit quality, such as the Government of Canada, have low credit risk. When credit quality is low, as is the case for low-rated bonds, credit risk is very high. Low credit risk equals high credit quality equals lower returns. High credit risk equals low credit quality equals potentially higher returns. Credit quality is rated by firms including Moody's and Standard & Poor's. They provide bond ratings and ratings for many other investments and financial institutions. Insurance companies that offer exceptional financial security receive a top rating, such as AAA. Insurance companies rated C are the lowest rated class and can be regarded as having extremely poor prospects of offering financial security. 1.4.9 Industry risk. Industry risk is the risk faced by specific industries, such as technology or mining. For example, the retail industry could experience consumer indifference to products, an inability to control costs, or a disruption among suppliers. Investments that experience industry risk include those that focus on specific industry investing, such as mutual funds. January 4th, 10 other investing risks. There are many investing risks, both general and specific. Agents and investors must be knowledgeable about the risks associated with investments to determine if such risks are within investor risk tolerance and risk capacity. Chapter 2. Segregated funds. Competency component. Analyze the available products that meet the client's needs. Implement a recommendation adapted to the client's needs and situation. Competency subcomponents. Analyze the types of investments that can constitute a segregated fund and that meet the client's needs. Analyze the advantages and limitations of segregated funds in comparison to other types of investments in regard to the client's needs. Propose a recommendation adapted to the client's needs and situation. 2. Segregated funds. Segregated funds are an investment that is exclusively created by life insurance companies. Their key characteristics have been introduced in Chapter 1 and will now be examined more closely. Segregated funds are offered through an insurance contract and they come with guarantees that protect their value. They are a suitable investment for those who want investment income or growth through exposure to the financial markets and, yet, want to limit risk. Segregated funds are an alternative to other fund investing and they provide many advantages to their investors. 2.1 Advantages of segregated funds. The following advantages of segregated funds are discussed in the next pages. Guarantees. Growth secured by reset. Funding flexibility through ongoing deposits. Ease of monitoring value. Guaranteed income. Professional management. Diversification. Tax benefits. Switches between funds. Ability to withdraw, redemption. Exemption from probate fees. Investor protection. Protection from creditors. Absence of medical underwriting. Right of rescission. 2.1.1 Guarantees. Segregated funds provide two guarantees that protect the investor from the loss of principal, a maturity guarantee and a death benefit guarantee. The maturity guarantee applies on the maturity date of the contract. The minimum maturity date is 10 years, never less, from the time the first deposit, or premium, is paid to the insurer, although some contracts offer maturity dates much longer than 10 years. A contract never matures before 10 years. The maturity guarantee ensures that, on the maturity date, an amount that is equal to at least 75% of the amount the policy owner deposited to the contract is paid out. The death benefit guarantee applies throughout the entire term of the contract. It applies whenever the annuitant dies during the contract, and is equal to, at least, 75% of the sum deposited to the contract. Withdrawals from the contract reduce the sum on which the guarantees are calculated. The minimum guarantee percentages, 75%/75%, remain the same and they are applied to the lower balance of the contract after the withdrawal is made. To best understand the guarantees, it is important to understand the roles of the parties to the contract. There are three parties. The first party is the person whose money, the principal, is deposited to the contract. This is the policy owner. He makes the investment decisions pertaining to the contract. He may also make withdrawals. The policy owner receives the policy proceeds when the contract matures and, therefore, is the person who benefits from the maturity guarantee. The second party to the contract is the annuitant. If the policy owner buys the segregated fund contract in an RRSP or a RRIF, the policy owner must be the annuitant of the policy. If the policy owner buys the contract in a non-registered, also called a taxable, account, the annuitant can be any person named by the policy owner. The annuitant is the person on whose death the death benefit is issued. The beneficiary is the third party to the contract. The policy owner names the beneficiary of the contract. If the annuitant dies, the beneficiary receives an amount that is equal to, at least, 75% of the initial deposit. Therefore, the beneficiary benefits from the death benefit guarantee. The minimum maturity guarantee and death benefit guarantee is 75% of deposits based on a 10-year term to maturity. Some contracts are structured to offer 100% guarantees. Often these contracts are based on a longer term to maturity, such as 15 years. Some segregated funds extend the maturity date to age 100 of the policy owner. Maturity and death benefit guarantees may be equal, 75%/75%, or the maturity guarantee may be less than the death benefit guarantee, 75%/100%. If the value of the contract at maturity or death is less than the guarantee, the insurer makes up the difference so that the amount paid out is equal to the guarantee. This is often referred to as a top-up. The life insurance agent assists the investor to choose a contract that provides the guarantees and term to maturity most suitable to his needs and objectives. The key pieces of information needed to understand how the maturity and death benefit guarantees apply and when they are paid are: what is the value of the principal, or premium, invested by the policy owner in the segregated fund? This is the sum on which the guarantee is based. What is the guarantee, 75% or 100%? This percentage is applied to the principal and determines the amount received on maturity and on death. What is the market value of the contract at maturity or death? 8. This is the sum that dictates whether a top-up is needed to equal the guarantee. 2.1.1.1 Maturity Guarantee. As previously mentioned, segregated funds are issued as an insurance contract with a minimum 10-year term to maturity. Some funds have a longer term to maturity, but none are shorter than 10 years. The maturity guarantee gives the policy owner the peace of mind of knowing that, no matter how the fund performs, the sum he will receive at maturity will be at least 75% of the amount he invested. This provides what is known as downside protection. It limits investment risk by establishing a minimum contract value payable at maturity. However, there is no maximum to what the value may be. This is called unlimited upside potential. On maturity of the contract, the policy owner has two options. He may withdraw the value of his investment or he may extend the contract and leave his investment in place. In either case, the insurer determines the market value of the contract and compares that sum against the contract. Maturity guarantee. If the market value is greater than the guarantee value, the policy owner receives the market value. If the market value is less than the guarantee value, the policy owner receives the guarantee value. Therefore, on maturity, the policy owner never receives less than the maturity guarantee, as illustrated by Table 2.1. When the market value is less than the guarantee value, the insurer makes up the difference between the market value and the guarantee from its financial reserves. In effect, the insurer tops up the market value to equal the value of the maturity guarantee. This top-up is paid to the policy owner in cash if the contract is terminated. If the contract is extended, the top-up is attributed to the account so that the value of the maturity guarantee may remain the same moving forward. The maturity guarantee applies only on the maturity date of the contract. Therefore, if a policy owner withdraws some units before the contract matures, he receives the market value of the units at that time. If the withdrawal is made and a sales charge applies, the applicable charges will be deducted from the withdrawal. The market value of the units may be greater than, equal to, or less than the value of the units when the deposit was made. There is no guarantee in regard to their value when surrendered. A partial withdrawal or full contract surrender before the maturity date does not receive the benefit of the maturity guarantee. As mentioned previously, withdrawals reduce the sum protected by the Guarantees but do not change the percentages of the guarantees. Example. Michael invests $10,000 in a segregated fund with a 75% maturity guarantee. The guarantee at maturity is $7,500, $10,000 times 75%. Scenario 1. At maturity, the fund has a market value of $8,360. This is greater than the maturity guarantee and it is the sum Michael receives. Scenario 2. At maturity, the fund has a market value of $6,360. This is less than the maturity guarantee. Michael receives $7,500, which comprises the market value plus a guarantee top-up of $1,140, $7,500 to $6,360. Scenario 3. At maturity, the fund has a market value of $13,200. This is the sum Michael receives without need for the maturity guarantee. Scenario 4. After 4 years Michael surrenders the contract. The fund has a market value of $7,120 and this is the sum Michael receives. Michael does not receive the benefit of the maturity guarantee because he has surrendered the contract before its maturity date. 2.1.1.2 Death Benefit Guarantee. The death benefit guarantee is a promise made by the insurer that the beneficiary of the segregated fund contract will receive at least 75% of the sum deposited to the contract if the annuitant of the contract dies during the term of the contract. Up to 100% may be paid. This percentage is set out in the contract. The death benefit is received by the beneficiary. The guarantee, whether 75% or 100%, is a minimum. The amount paid to the beneficiary as the death benefit is calculated the same way the maturity guarantee is calculated. It is based on the amount deposited to the contract, its market value at the time of death and the death benefit guarantee under the contract. The beneficiary receives the greater of market value or the death benefit guarantee. If the market value is less than the guarantee, the insurer makes up the difference between the two amounts. Similar to the maturity guarantee, the amount contributed by the insurer may be referred to as a top-up because the insurer tops up the lesser value in order to fulfill its contractual promise. There are 4 advantages to the death benefit guarantee. The beneficiary is protected from fund losses throughout the term of the contract, just like the maturity guarantee protects the policy owner. The guarantee applies from day 1 of the contract. Segregated funds are a long-term investment. But if there is a drop in market value in the short term and death occurs, the decrease in value is accommodated by the guarantee. Segregated funds do not require medical underwriting. Therefore, an older person or a person in ill health does not need to be concerned about poor market conditions at the time of his death. The guarantee gives him peace of mind that his beneficiary will receive at least 75% of deposits. Like the maturity guarantee, there is no upper limit to how much the beneficiary might receive if market conditions are favorable and unit values are high at the time of death. The death benefit may also be reduced by a sales charge. Some insurers waive these charges when the contract ends due to death. The value of the investment is further enhanced because it will not be subject to probate fees if there is a named beneficiary that is not the estate of the deceased. Example. Keith is the policy owner and annuitant of a segregated fund contract with a 75% death benefit guarantee. Keith funded the contract with a $10,000 bonus he received from his employer. The death benefit guarantee is, therefore, $7,500. $10,000 times 75%. His wife, Patricia, is the beneficiary of the contract. Keith dies during the 9th year of the contract. Scenario 1. At the time of Keith's death, the market value of the contract is $12,640. Patricia receives that amount since it is greater than the death benefit guarantee of $7,500. Scenario 2. At the time of Keith's death, the market value of the contract is $6,300, which is less than the guaranteed amount, $7,500. Patricia receives the death benefit guarantee of $7,500, which represents the market value of $6,300 plus a top-up of $1,200, $7,500 to $6,300. 2.1.2 Growth secured by reset. Market values of fund units go up and down. There is no predicting when values might change, or by how much. All fund investors hope to see their units continually rise in value. Typically, increasing values, if plotted on a graph, look like steps or a series of ever higher mountain peaks. Diagram 2.1 shows an increasing value with fluctuations. Segregated funds are unique in that they offer investors a chance to lock in an increase in value during the term of the contract in a process known as reset. So, when the value of the contract rises due to fund performance and it achieves a new high, the investor can set the contract value at that higher level. If losses subsequently occur in fund value, there is no impact on the investor, because he captured his gains at the higher value. This process can be repeated over and over, limited by the conditions of the contract, ratcheting up the contract value at ever greater worth. This is a unique feature of segregated funds, and the ability to participate in gains and hold on to them moving forward has incredible potential for the investor. There is a downside to reset. It also has the effect of increasing the maturity and death benefit guarantees and changing the contract's maturity date. The new maturity date of the contract is 10 years from the reset date. Both the policy owner, through the maturity guarantee, and beneficiary, through the death benefit guarantee, can benefit from reset. Example: an investor deposits $20,000 in a segregated fund. The 75% maturity and death benefit guarantees are $15,000, $20,000 times 75%. If the market value increases to $50,000 in the fourth year of the contract, the guarantees will now amount to $37,500, $50,000 times 75%, if the contract is reset. Some insurers offer an automatic reset on segregated fund contracts in which the insurer automatically locks in growth of the account value. Others put the decision to reset into the hands of the policy owner. Regardless of who resets the contract, the maturity date is extended when it is reset. Therefore, reset may be attractive to an investor who is oriented towards fund growth and increasing his investment returns. However, reset may not appeal to an investor who has a strict 10-year time horizon for his investment. Not all insurers offer reset on their segregated funds. If reset is available, and it is up to the policy owner to make the reset decision, he does not have to reset the contract because he may not want to extend its maturity date. Example: Hassan deposits $5,000 to a segregated fund contract with a 75% maturity guarantee and 75% death benefit guarantee. Each guarantee is worth $3,750. $5,000 times 75%. After 2 years, the market value of the contract is $7,000. Hassan's contract offers reset and he chooses to reset the contract. This increases the maturity and death benefit guarantees to $5,250, $7,000 times 75%, and resets the maturity date of the contract. His contract now matures 10 years from the reset date, 12 years from the time of the initial deposit. There may be limitations to reset, such as an additional fee charged annually to contracts in which reset is permitted. Also, an insurer may offer reset on the maturity guarantee separately from the death benefit guarantee. If so, the investor could choose to reset the maturity guarantee but not the death benefit guarantee, or vice versa. The insurer provides information regarding the number of resets allowed and the mechanisms to Request or accept a reset in the information folder provided at the time of sale of the fund. 2.1.3 Funding flexibility through ongoing deposits. The principal deposited to a segregated fund contract is called the deposit or premium. It can be contributed as a lump sum or as a series of deposits. When a series of deposits is made, the maturity guarantee may be applied to the individual deposit dates or to the date of the contract. Most commonly, the guarantee is based on the deposit date or dates. Each deposit has its own maturity guarantee of 75% or 100% of deposit value, the length of which is based on the term to maturity in the contract, 10 years or more. Therefore, Deposit 1 has a maturity guarantee that applies from its deposit date. Deposit 2 has a maturity guarantee from its deposit date. Deposit 3 has a maturity guarantee from its deposit date, and so on. Example: Sandra has a deposit date-based segregated fund with a 10-year term to maturity. She deposits $2,000 as an initial deposit and then $2,000 every year thereafter on January 1st for 2 years for a total of 3 separate deposits. At the start of her contract, her maturity guarantee is $1,500, 1 times, $2,000 times 75%, in 10 years. At the end of 11 years, her maturity guarantee is $3,000, 2 times, $2,000 times 75%. At the end of 12 years, her maturity guarantee is $4,500, 3 times, $2,000 times 75%. 2.1.4 Ease of monitoring value. An investment in a segregated fund provides the investor with an assigned number of units. The number of units assigned at the time of purchase is a result of how much is invested and their fair market value. Every fund has its own unit value. This is also true of mutual funds. It is essential for the investor to know the value of units when they are assigned if he wishes to follow performance and monitor changes in value. An increase may indicate that a reset is in order. A decrease could suggest a fund switch is in order. Example: an investor invests $1,000 in ZYX fund, in which units have a market value of $10. He is assigned 100 units, $1,000 divided by $10. If the market value of the units increases to $12, his investment will be valued at $1,200, $12 times 100. A unit value is determined for each fund. The value is called the NAV or net asset value per unit. The term NAV, or net asset value, is also used. It is calculated as NAV equals total value of assets, liabilities, number of units outstanding. The NAV is determined on each valuation day. For a fund investing in Canadian equities, a valuation day is a day that the Toronto Stock Exchange is open. Therefore, if a valuation shows an increase in NAV, the market value of the investment has increased. Unit values increase and decrease in step with the value of assets held within the fund. However, the number of units assigned to the investor does not change unless he makes an additional deposit. In other words, he buys more units, or a withdrawal, by selling units. Allocations are another way an investor benefits financially from his segregated fund. Segregated funds allocate taxable income and realized capital gains and/or losses to non-registered contract owners. Investment growth in a fund is generated in the form of interest, dividends, and capital gains. These earnings are not distributed to investors in the form of cash. Instead, the allocations change the adjusted cost base of the units but not their NAV. Interest, dividends, and capital gains increase the ACB. Capital losses decrease the ACB. The change to the ACB is tracked by the insurance company. If an investor wants cash from the fund, he must make a withdrawal by redeeming fund units. 2.1.5 Guaranteed income. A segregated fund contract typically returns its value on maturity in a lump sum payment. Alternatively, a contract may create a guaranteed stream of payments. This feature may be added to an existing contract or be part of the conditions upon issue. Such a contract is available in two forms: the Guaranteed Minimum Withdrawal Benefit, GMWB, and the Guaranteed Lifetime Withdrawal Benefit, GLWB. Like all segregated fund contracts, these withdrawal benefit plans provide a maturity and death benefit guarantee. They are differentiated by the regular payments they provide, which is often compared to income because of the regularity with which the payments are made. This is one reason that withdrawal benefit plans are attractive to retirees. Not all insurers offer contracts that can provide regular withdrawal benefits. Also, there are many features, options, and restrictions that differ between these plans as offered by different insurers. Due to their complex rules and requirements, they may not be suitable for all investors who seek income. 2.1.5.1 Guaranteed Minimum Withdrawal Benefit, GMWB, and Guaranteed Lifetime Withdrawal Benefit, GLWB. Both the GMWB and GLWB plans are based on an initial deposit or deposits by an investor to a segregated fund contract. The GMWB provides a regular income over a set period of time. The GLWB pays income for life. Investors may begin making withdrawals immediately after entering into a contract, or they may choose to wait before starting to make withdrawals. Those who wait have two phases to their plans: a savings phase and a payout phase. The savings phase is a period of accumulation. During the savings phase, investors receive the potential for increase in fund market value. They also earn a credit every year in which a withdrawal is not made. The credit is based on a percentage of the initial deposit. For instance, the credit may be 5%. The value of the initial deposit plus the annual credits form a base on which a guaranteed minimum withdrawal is based. Any withdrawals during the savings phase reduce the value of the initial deposit and thus of the corresponding credits and final guaranteed minimum withdrawal amount. The payout phase starts when regular withdrawals begin. During the payout phase, the investor receives an annual income based on the guaranteed minimum withdrawal balance created during the savings phase. As withdrawals are made, the value of the contract declines. However, the annual income guarantee is not affected. It is also insulated against poor market performance of the fund so that the same annual income is received even if the market value decreases. Extra withdrawals can be made that exceed the guaranteed income payment. They may be penalized with fees and, like all withdrawals, reduce the base used to determine future guaranteed income. The payout value may be reset every 3 years. Reset creates a potential for increased income. If the market value of the contract has increased, provided additional withdrawals have not been made. The payout also increases if more premiums are contributed after the initial deposit. The amount received is based on the payout beginning at a specified age and lasting for either a specific period of time, such as 20 years or for life. A lifetime payout will be at a lower rate than if income is taken for a specified period because the contract value is stretched over a potentially longer time. This is similar to the payment made from a life annuity compared to a term annuity. One of the risks faced by retirees is the risk that they might outlive their financial resources. This is called longevity risk. Lifetime income appeals to those with this concern and is why individuals buy guaranteed lifetime withdrawal plans and life annuities. Both products address longevity risk. 2.1.6 Professional Management. Segregated funds employ professional investment managers to provide investment management and advice. These managers are compensated by fees, which are part of the management expense ratio, MER, charged against fund assets to investors. The investment managers are hired by the insurance company offering the segregated fund or funds. The insurer retains the right to appoint or change a manager. A management change is reported to investors. The fund manager is a highly educated and well-trained investment professional. The average investor has neither the time nor the expertise to compete with the typical fund manager. By leaving investment decisions in the hands of the fund manager, the average investor can achieve his investment objectives without having to be actively involved in the day-to-day management of his investments, thereby eliminating the obligation to make ongoing decisions. This never alleviates the life insurance agent's responsibility to work with the client to ensure his objectives are being met in the fund investment. The agent must be prepared for regular client meetings in which performance and other factors about the fund will be discussed. 2.1.7 Diversification. Segregated funds are highly diversified investments. This means their managers use a wide range of investments suitable to the type of fund. For example, an equity fund is highly diversified because it holds shares of many companies. Diversification is a key to investing success. It lessens risk for the average investor since risk is spread over all the investments held in the fund. And, even in the unlikely event that all diversified assets in a segregated fund were to lose all their value, the segregated fund investor would be protected to a maximum loss by his maturity and death benefit guarantee. 2.1.8 Tax benefits. Segregated fund investing offers several tax advantages compared to mutual funds. The ACB of a segregated fund is tracked by its insurer and there is virtually no possibility for error. This simplifies annual tax reporting, unlike a mutual fund in which the investor must take responsibility for reporting transactions. The interest, dividends, and capital gains earned in a fund are reinvested in that fund. They increase unit value and increase the investor's adjusted cost base, ACB, per unit. The ACB is a calculation that determines the tax cost of an investment to its investor. Increasing the ACB reduces tax when the units are sold. The investor with a non-registered account receives the earnings on a flow-through basis. This means interest earned in the fund is reported for tax purposes to the investor as interest. Dividends earned are reported as dividends, and capital gains and losses earned are reported as such. Capital losses are used to reduce capital gains in the year in which the loss occurs. If a loss cannot be fully used in that year, it can be carried back to the 3 previous years or forward indefinitely. This gives the investor the ability to choose when to claim his capital loss. Finally, but not to be overlooked, is that proceeds of segregated fund death benefits are probate free when a beneficiary is named. Probate, though not precisely a tax, operates as a tax on the value of an estate remaining after death. Example: Henry invests $1,000 in WWW Seg Fund Series B on September 1st in his non-registered account. He is assigned 200 units on the basis that each unit is worth $5. $1,000 divided by $5 equals 200. At the end of the year, a $100 allocation is made to Henry's policy and the unit value is fixed at $6 due to fund growth. Henry now has 200 units worth $1,200 and each unit is worth $6, $1,200 divided by 200. The ACB of Henry's policy is now $1,100, the initial $1,000 investment plus the $100 allocation. The $100 allocation Henry received is reported on a tax slip issued by the insurer to Henry as $50 in interest and $50 in capital gain. The interest is taxed at Henry's marginal tax rate. The capital gain is also taxed at his marginal rate. But only 50% of the gain is taxable. $50 times 50% equals $25. If Henry's marginal tax rate is 36%, he pays $18 tax on the interest he receives. $50 times 36% equals $18. He pays $9 income tax on the capital gain. $25 times 36% equals $9. 2.1.9 Switches between funds. A lot can happen to an investor during the term to maturity of a segregated fund. He can become more risk-averse or more risk-tolerant. He can become frustrated with performance that is lower than expected or dissatisfied with a high MAR. Switching from one fund to another may alleviate investor concern, and a new fund may better suit his objectives. Whatever the reason, the investor who wants to switch his account value from one fund to another may do so with a segregated fund investment, aided by the life insurance agent who recommended the fund investment. The investor who contemplates a switch must be provided with the same information documents for the new fund as were received at the initial purchase before the switch occurs. This includes both the information folder and fund facts for the new fund. When the switch is being made, the value of the existing fund units is determined on the valuation date, which is either the day of the switch request or the following day. This is the sum that will be used to acquire units in the new fund. There is typically a minimum amount that can be transferred. Contract guarantees are not affected by fund switches. The number of switches the investor may make per year without incurring a switching fee may be limited. Individual funds state their switching policy in the information folder provided to the investor. An investor may incur a tax liability when a switch is made. An investor who switches funds where each fund charges the same load, e.g., a front-end load, FEL, will not incur a fee for the switch. However, there may be a fee for switching between funds with dissimilar loads, e.g., a no-load fund to an FEL. The insurer will state their policy for fees on switches in the information folder of the fund. February 1, 10 Ability to withdraw, redemption. The investor enters into the segregated fund contract with the intention of seeing the contract mature in at least 10 years, i.e., the term of the contract. However, his financial circumstances can change during this period, and he may find he needs to make a withdrawal from the contract to receive cash in hand. A withdrawal is also known as redemption. The investor may make a withdrawal at any time. This provides him with investment flexibility. The withdrawal process begins by the investor informing the insurer that issued the fund contract of the amount he wishes to withdraw. The investor redeems the number of units that will provide the desired sum of money based on their market value. The market value is determined at the valuation day following the request. The investor receives the money from the insurer within days of the valuation date. The maturity guarantee and death benefit guarantee of the contract are reduced as a result of the withdrawal because the investor has fewer fund units. The insurer calculates the new guarantees according to the terms of the contract. A withdrawal may trigger tax. The contract owner receives a tax reporting slip from the insurer so that the withdrawal may be taken into consideration in the tax return for that year. February 1, 11 Exemption from probate fees. Probate is the process in which the will of a deceased person is proven to be valid and the person appointed as executor of the will is accepted. It occurs in the provincial home court of the deceased and is finalized when letters probate or an equivalent document is issued. Probate fees are a charge by the province or territory against the value of a deceased's estate. Only Quebec and Manitoba do not charge probate fees. There are great differences between both how much each province charges as the probate fee and what assets are included in the estate for the purpose of probate. Probate fees must be paid by the estate of the deceased before any property can be inherited as specified in the will. They can significantly reduce estate value in a province, such as B.C., that does not put an upper-end cap on probate fees. Some exceptions apply to the requirement to pay probate. Probate fees are not charged to trusts or when a surviving spouse inherits assets. Probate fees also do not apply when the beneficiary of a segregated fund contract is not the estate. A named beneficiary receives the proceeds from the contract probate-free. This includes the spouse, parents, children, and grandchildren of the contract owner or annuitant. The ability to put the proceeds into the hands of the beneficiary without going to probate is one of the single most important benefits of segregated fund ownership. Potentially, thousands of dollars in probate fees can be saved. However, there will be no saving if the estate is named as beneficiary. If the estate receives the proceeds, it becomes part of the total estate value and subject to probate fees. Also, segregated funds are redeemable on each valuation day. Therefore, the account value can be received by the beneficiary within days instead of the months it takes when an estate must go through probate. February 1st, 12 Investor Protection. Assurus steps in to provide investor protection when an insurer becomes insolvent and cannot meet its financial obligation to pay guarantees. Assurus facilitates a quick transfer of policies from the insolvent insurer to another insurer that has the financial capacity to honor guarantees and benefits. 2.1.12.1 Guarantee exceeds market value. Assurus protection is needed only when the guarantees of the segregated fund investment at maturity or death are higher than the market value of the fund. When market value is greater than guarantees, there is no need for Assurus participation since the market value can fund the obligation of the guarantees. Assurus guarantees a segregated fund contract owner will retain up to $60,000 or 85% of guarantees, whichever is higher. In other words, it allows a segregated fund contract owner to retain 100% of his guaranteed investment if it is equal to or smaller than $60,000. For investments valued at more than $60,000, contract owners will retain 85% of guarantees. Example: Mark has deposited $100,000 to his segregated fund account and the contract has a 75% maturity guarantee. Therefore, Mark is guaranteed to receive $75,000 on maturity when his insurer is unable to pay the maturity guarantee. Due to insolvency, Assurus coverage is applied. Mark is going to receive the greater of $60,000, or $75,000 times 85%, $63,750. Therefore, Mark receives $63,750 since it is greater than $60,000. February 1st, 13 Creditor Protection. A creditor is a person or business to whom money is owed by a borrower, i.e., if I loan money to you, I am your creditor. A creditor may make a court claim for money owed if the borrower fails to make good on repayment. Segregated funds provide the potential for protecting contract owners from the claims of creditors. In other words, if the segregated fund policy owner owes someone money, that person cannot claim the value of the segregated fund to repay the debt. Segregated funds provide this protection because they are insurance contracts and claims are not successful if the spouse, parent, children, or grandchildren are named as beneficiary in the contract, if the beneficiary is irrevocable, or if the account is a registered account. A person must not, however, try to avoid creditor claims by investing in a segregated fund. For this reason, it is necessary for the segregated fund contract to be acquired for the purpose of investment, not for the purpose of avoiding creditors. February 1st, 14 Absence of medical underwriting. There is no medical underwriting of an application for a segregated fund contract. This means that the health of the contract's policy owner or annuitant is not assessed because guarantees are based on the strength of the investment and not a person's life. It makes no difference to the contract if the policy owner or annuitant has a health condition or shortened life expectancy at the time of application. If the policy owner or annuitant dies during the contract, the death benefit guarantee ensures the beneficiary receives the guaranteed minimum payment. Therefore, a policy owner or annuitant does not need to be concerned about the risk that he may die at a time when the contract has temporarily lost value. His beneficiary will receive the greater of the guaranteed proceeds or the market value of the contract. February 1st, 15 Right of rescission. The right to cancel a contract is known as the right of rescission. All insurance contracts provide this right. An investor may cancel or rescind the segregated fund contract in writing within the specific time limitation set by the insurer providing the contract. 2 days is the usual length of time permitted. The investor receives the lesser of the amount of premium paid or value of fund units on that date if it is a valuation date. If it is not a valuation date, then the value on the next valuation date applies. By comparison, there are no rescission rights with mutual funds or ETFs. 2.2 Types of segregated funds. There are numerous segregated funds offered to investors. As stated in Chapter 1, the Canadian Investment Funds Standards Committee, CIFSC, classifies all fund investments into categories by asset class. Its 5 asset classes are cash, fixed income, equity, commodity, other. This is a helpful starting point to understand the many types of funds since each class shares certain characteristics. Also, many funds have subcategories that narrow their investment objective. Analysis of fund holdings and quick facts in the Fund Facts document tell the bottom line about objectives and suitability. However, the actual names of funds often bear little relationship to the asset classes and categories defined by CIFSC. For instance, a fund called a creative portfolio does not reveal its asset class in its name. The agent must dig into details about top investment holdings in the fund to better understand how the fund may be classified so that comparisons against similar funds will be accurate. Proper classification is important so that funds can be correctly compared and aligned with investor risk tolerance. For instance, if an investor has a low tolerance for risk, then he will not be suited for a fund classed as an equity fund. His better choice will be a lower risk fund, such as a bond fund invested in government bonds. Each fund is highly diversified. Top holdings are described in the Fund Facts document or information folder. Other holdings for each fund may be too numerous to list. 2.2.1 Money Market Funds. Money market funds must invest at least 95% of their total net assets in cash or cash equivalents, such as Government of Canada short-term bonds or Treasury bills. 9. Money market funds are the lowest risk funds and, correspondingly, have a low rate of return. 2.2.2 Bond funds. Bond funds are a fixed income type of fund. These funds must invest a specified percentage of their holdings in fixed income securities such as bonds and Treasury bills. Fixed income funds may be categorized according to the duration of the bonds held by the fund. For instance, the bonds in a short-term bond fund mature in less than 3.5 years. Bonds in a medium-term fund mature between 3.5 and 9.0 years, and bonds in a long-term bond fund mature in 9.0 years or longer. Fixed income funds are described in the currency of the security held in the fund, e.g., Canadian dollar-denominated securities in a fund refer to a Canadian fixed income fund. 10. Fixed income funds are generally low risk and have a low rate of return. Some funds may invest in securities with a lower credit rating in order to achieve a better return. These funds may be called high yield. High-yield bonds are also known as junk bonds, and such funds carry much higher risk than traditional bond funds. 2.2.3 Equity funds. Equity funds are also known as growth funds. They invest in stocks of publicly traded companies and income trusts to generate dividend income and capital gains. An equity fund may be diversified across different types of businesses or concentrated in a particular sector, such as financial services. Even when focused on a specific industry sector, the fund will have many holdings in that sector and will be highly diversified. However, higher levels of risk are experienced when an equity fund is concentrated in one sector even though it will be diversified in that sector. Such a concentration means the fund is susceptible to industry risk in its sector. Fund growth is achieved when stocks held by the fund are sold at a higher price than their purchase price and by reinvesting dividends paid on fund holdings. The increase in price is the capital gain on the stock. There is a higher degree of risk with an equity fund than with other types of funds. Stocks and stock markets are highly volatile. Price swings can be significant. Company fortunes and prospects rise and fall in part due to factors that cannot be predicted, such as investor mood and sentiment. This makes the profitable buying and selling of stocks challenging for even the most experienced investment manager. This is the nature of equity risk. 2.2.3.1 Equity funds by market capitalization. Market capitalization, or cap, is a category of equity funds that give an investor the opportunity of fine-tuning their risk level to company size. The larger the market capitalization, generally the lower the investing risk. The cap is simply a range that shows how large a company is. Large cap funds, mid cap funds, and small cap funds are the most common. However, there are also mega caps, $200 billion plus, micro caps, $50 to $300 million, and nano caps, less than $50 million, 11. For example, Royal Bank of Canada is a large cap company with a market cap of $140.64 billion, May 2022. Air Canada is a medium cap company with a market cap of $6.04 billion, May 2022, and Extendicare is a small cap company with a market capitalization of $649.33 million, May 2022. 2.2.4 Income funds. Income funds are based on bonds, and growth is derived by the regular interest income the bonds pay and their possibility for capital appreciation. Some income funds may also hold high-quality stocks. When stocks are included in the income fund portfolio, the unit owner may receive both dividends and capital gains from his investment. Both government and corporate bonds may be held in income funds. Income funds are a lower risk fund. 2.2.5 Balanced funds. As the name suggests, balanced funds aim to strike a balance, in their case, between stocks and the growth potential they represent, and fixed income, and the safety the category represents. Balanced funds are also known as balanced growth or balanced income funds. A balanced growth fund emphasizes stocks. A balanced income fund emphasizes bonds. The risk associated with these funds depends on how the balance is weighted. Stocks are higher risk, bonds are lower. When there is an even split, risk is averaged out. Balanced funds suit an investor who wants some exposure to stocks but is not prepared for the volatility of stocks alone. 2.2.6 Target date funds. A target date fund combines equity and fixed income investments. Its objective is to decrease risk over time. At the time of the investment, the investor picks a target date, usually the date he intends to retire, but it can be any date or any age. Over the duration of the investment, the asset allocation gradually and automatically shifts from a higher to a lower level of risk as equities, such as stocks, are replaced with fixed income products, such as bonds. It is not uncommon for risk tolerance to decrease with age because later in life an investor generally has very limited ability to make up for investment losses. Therefore, a target date fund is a good choice to see an investor into retirement and beyond. Target date funds are often a default option for anyone who is in a pension plan, and they are a popular choice among less sophisticated investors thanks to their easy-to-understand concept. 2.2.7 Dividend funds. A dividend fund invests in companies that have a history of paying dividends. A dividend is a distribution of a percentage of company profits by the board of directors to company shareholders. They are not guaranteed, but the obligation to meet dividend payments is taken very seriously by a company and its investors. Dividends received from Canadian corporations are taxed at a lower rate than interest income as a result of the dividend tax credit. This increases investor appeal. A dividend fund may also invest partly in bonds. Dividend funds are considered low to medium risk. 2.2.8 Mortgage funds. A mortgage fund holds residential, commercial, and industrial mortgages. When mortgages have a higher degree of risk because the underlying assets are riskier, mortgage funds are categorized as another asset class. Low-risk mortgage funds are a type of fixed-income fund. Default risk is associated with a mortgage fund. It is experienced when mortgage holders default on, i.e., fail to make their mortgage payments. 2.2.9 Real estate equity funds. Real estate equity funds must invest at least 90% of their assets in retail, commercial, industrial, and residential properties. 12 They earn income from mortgages and have potential for capital gains as property values increase. Real estate funds own property, mortgage funds do not. Some funds invest in real estate investment trusts, REITs, companies that, in turn, invest in real estate. The risk of each fund will be a result of the types of properties in which the fund invests and their location. Real estate funds are particularly suitable for long-term investment because property values need to be given enough time to rise in value. Real estate is an illiquid investment. In cases when real estate values are low due to market conditions, investors may not be able to exercise their redemption privileges due to the illiquid nature of the underlying investments. February 2, 10 Index funds. An index fund is a mirror of an index, such as the S&P/TSX Composite Index, that invests in the same stocks that are listed on the index. Therefore, if the index rises, the index fund will also rise. Its results will be slightly less than the actual index because of the fees that are charged to the fund. This form of investing is known as passive investing because the investment manager mimics the index chosen for his particular fund and maintains the same securities in the same weight. There are many indexes on which funds may be based. They include equities, bonds, commodities, currency, and real estate among others. The risk of a fund is a result of the underlying market the fund tracks. February 2, 11 Fund of funds. A fund of funds is, as its name indicates, a fund that invests in other funds. The purpose of this approach is to benefit from managerial expertise in other funds and to diversify. The fund manager decides which funds suit the portfolio based on the fund objective, and he rebalances holdings as needed to maintain the objective focus. The risk of the fund is entirely a result of the underlying funds in the portfolio and its investment objective. February 2, 12 Specialty funds. Some funds are created to appeal to specific investor wants and respond to investor needs. They are called specialty funds. Specialty funds do not have the mass appeal or assets of their large segregated fund cousins, such as equity funds. However, specialty fund categories such as socially responsible funds fill important investment objectives for their investors. Socially responsible funds provide an alternative for investors who, for religious, political, environmental, or moral reasons, find the holdings of standard funds unacceptable for investment. Investors seek funds that align with their investment objective, such as the investor's desire to invest in green energy. Investors are less concerned about the risk of the fund since their primary goal is to support a cause or belief. Other specialty funds include emerging markets funds or funds that seek companies that are struggling financially. Once again, there are many specialty funds to choose from. The risk of specialty funds lies with the fund's objective and investment strategy used by the fund manager. Each one should be carefully studied to determine if its risk is suitable for the investor. 2.2.1 Industry-specific funds. An investment manager who has an interest in a specific industry, or the belief that an industry will flourish in the economic conditions of today or the future, may create a fund that specializes in that industry. Such industries may be well established or feature new technology, services, or products. The landscape is constantly evolving. Risk of industry-specific funds depends on the industry that forms the basis for the fund, its volatility and its prospects. 2.2.12.2 Geographically specific funds. Certain funds focus on the investments within a country, e.g., Canada. Outside the boundaries of a country, e.g., North America. Of a selection of countries, e.g., international. Of a region, e.g., Asia. Of part of a region, e.g., Asia except Japan. Of the entire globe. Countries change in their appeal to investors over time. Some become very attractive investment opportunities while others lose their appeal. Funds with a geographical focus reflect such changes. Political volatility is a risk associated with investing outside Canada and similar developed nations. Currency risk is another. An investor who seeks foreign opportunities should be well aware of the political situation and economic stability of the country or region in which he plans to invest. He should also monitor changes that might affect the investment, example an election. February 2, 13 New introductions. Funds evolve over time based on consumer interests. New funds are created for a variety of reasons, including to offer new investment opportunities or to provide new features. Funds that have lost their appeal are closed and may be amalgamated with other funds. February 2, 14 Suitability of funds. Whereas those who recommend and sell stocks, bonds, and mutual funds are being tasked with client-focused reforms to put best interests of their clients first, insurers and their intermediaries are expected to implement the principles of the Fair Treatment of Customers, FTC. In both instances, suitability of investments for the client is a priority. FTC is relevant to the choice and recommendation of funds by the agent. He is required to act ethically and in good faith and is prohibited from engaging in abusive practices. The agent must meet the investment needs of the client without conflict of interest or influence by commission or incentives. He must be objective, honest, diligent and professional. To do so, the agent will sell products in a way that pays due regard to the interests of clients. Provide clients with accurate, clear, non-misleading, and sufficient information before, during and after the point of sale, to allow them to make informed decisions. Minimize the risk of sales which are not appropriate to the client's needs. Ensure that any advice given is of a high quality. Deal with clients' claims, complaints, and disputes in a fair and timely manner. Protect the privacy of client information. Example. Claude has met with Andre twice to introduce
Segregated Funds and Annuities. Chapter 1. Segregated Funds and Annuities. Chapter 1. Investment and Savings. Competency Components. Assess the client's needs and situation. Analyze the available products that meet the client's needs. Implement a recommendation adapted to the client's needs and situation. Competency subcomponents. Determine the client's situation, investment objectives, and investor profile. Articulate the client's needs based on the risks that could affect his financial situation. Analyze the advantages of segregated funds in comparison to other types of investments. In regard to the client's needs, propose a recommendation adapted to the client's needs and situation. 1. Investment and savings. Segregated funds and annuities are investment and savings products marketed to individual and group prospects and clients. Segregated funds are exclusive to the life insurance industry. Only licensed life agents can represent segregated funds. Some annuities are also exclusive to the life insurance industry. Others are sold both by licensed life agents and by other financial institutions, such as banks. Segregated funds and annuities provide guarantees to investors. They can help some investors reach their financial objectives, such as retirement. Many options are available for those who save and have the desire to invest those savings. Every option has features suitable for some investors, but not others. The life agent has a duty to clients to identify which investment is in their best interest, to represent information fairly and to know the limits on the advice he is authorized to give. 1.1 Investment and Saving Principles. There are certain time-honored principles that apply to investing and saving. It is essential to understand these basics, which are the foundation of all investing and saving, before focusing on segregated funds and annuities in particular. 1.1.1 Concept of investing. Investing can only begin when an individual has savings in the bank or has the ability to set money aside from income that can be earmarked for savings. You may find that some coaching is required to get your client on the path to saving, so that investing can begin and wealth is accumulated. How can saving be simplified and encouraged? There are some old standby methods that have stood the test of time. They include: pay yourself first. Make savings an item on the budget, just like any other expense. This reduces the temptation to spend. For instance, a pre-authorized contribution, PAC, or pre-authorized deposit, PAD, to a savings or investment account is a highly effective way to build savings. Save 10% of take-home pay. Exactly as its name says, but the percentage may need adjustment according to individual circumstances. Save exceptional payments. Save money received from an income tax refund or a work bonus. Set up savings buckets. A savings bucket has a dedicated purpose. It is rewarding to see savings goals for specific objectives being reached and can reinforce savings habits. Buckets could include retirement, holidays, or big-ticket items such as a car. Budgeting. Budgeting is crucial for managing day-to-day finances and allocating a sum for saving. When savings have accumulated or can be earmarked, then it is time to start considering how to grow that money through investing. Investing is the process of using savings to purchase investment products with the goal of making money. A business invests money in new equipment, for instance, that will help it make more products faster or cheaper. The business profits from its investment. The goal of individual investors is to invest a sum, called principal or capital, in an investment product that will be repaid to the investor plus a profit. That profit is called the return. Many investment products are available for individual investors. Some investments guarantee that the full amount invested will be repaid plus a profit. These investments include guaranteed investment certificates, GICs, and some bonds. Other investments do not guarantee that the amount invested will be repaid. These non-guaranteed investments include stocks, mutual funds, and real estate. Example: Jean is 78 years old and depends on the returns from her investments to generate income to support her in retirement. Her investments, combined with her pensions, allow her to live comfortably. Jean feels that she cannot afford to risk her invested money in an investment that would not pay both her principal plus the stated return. Therefore, Jean chooses guaranteed investments to ensure that she will not experience losses. Where does segregated funds and annuities stand in respect to such guarantees? This chapter and this manual describe how these insurance investments provide guarantees, to whom, and when. 1.1.2 Investment Basics. Some investment basics are fundamental to understanding how investing works, how returns are generated for investors, and how investors manage risk. 1.1.2.1 Compounding. Compound interest. Compounding is a concept that is basic to investing. It is a very powerful investing tool. Interest on an investment may be paid daily, monthly, quarterly, or annually. The investment may permit withdrawal of the interest or for the interest to be added to the value of the investment. When it is added, or reinvested, the value of the investment grows. At the time of the next interest payment, interest is calculated and paid on the total investment value. That value is a sum of principal plus interest previously paid. As a result, the investor earns interest on interest. This form of interest is called compound interest. In order for compounding to work to its maximum potential, all investment returns must be
reinvested. Withdrawals diminish or eliminate compounding. Unfortunately, compounding also has a negative side since costs can also compound. Debt, in which an outstanding unpaid balance is charged interest, also compounds. 1.1.2.2 Investment returns. All investments have one of three types of return. Returns can be positive and reflect a profit earned from the investment. Returns can be neutral, in which the investor receives the sum initially invested plus any fees paid. He is back where he started. Returns can also be negative. In this case, the investor will not receive back all the money invested. This is a risk of investing. The return is often expressed as a percentage of the amount invested. In those cases, it is called rate of return. It can be a positive number, such as 10%, or a negative number, such as minus 10%. Example: Salim invests $10,000 but receives $11,000 when he sells the investment. The $1,000 profit, $11,000 to $10,000, is a 10% rate of return. $1,000 divided by $10,000. In some cases, investors may be informed of the expected rate of return on an investment before they invest. In others, it is impossible to tell investors what to expect because the return cannot be accurately predicted. This is a characteristic of a risky investment. There is also a scale of risk expressed for investments, which is a guide to the investor about how likely it is that he will receive all his money back. The scale of risk plots the amount of risk an investor takes on in a range between the bottom of the scale, which is very low risk, and the top of the scale, which is extreme, called speculative risk. An investor with a very low risk investment can be very confident that he will receive back all his invested money. Speculative investments are the most risky. An investor who makes a speculative investment knows that he may not get back all the money he has invested. There is a very high degree of risk that he will experience a negative return and lose money. However, there is also a possibility of very high returns and earning a significant profit. Moderate or balanced risk investments are in between the two ends of the risk spectrum. Why would an investor consider risky investments? Risky investments provide the opportunity for far greater positive returns than those with lower risk. This concept underlies investment risk/return theory. It is based on rewarding those who are prepared to risk their money with a better return. Investors who are not willing to risk the loss of their money receive a lower rate of return. Returns are classified as nominal returns or real returns. A nominal return is the stated or advertised rate. For example, a savings account is advertised with a 2% return. That is its nominal return. Real return is calculated as the nominal return on an investment minus the rate of inflation. It can be positive, showing a profit, or negative, showing a loss. Example: in 2020, if the annual nominal return on a guaranteed investment certificate was 3% and the annual rate of inflation was 1.8%, then the real rate of return on the bond was 1.2%, 3%, 1.8%. In 2022, if the annual nominal return on a guaranteed investment certificate is 3% and the annual rate of inflation is 5%, then the real rate of return on the bond is -2%, 3%, 5%. 1.1.2.3 Asset classes. Asset classes are categories assigned to investments that have similar characteristics and are governed by similar laws and regulations. The three main asset classes are stocks, also called equities, bonds, also called fixed income or debt, and cash, also called money market instruments. Two other classes are often added. They are real estate and commodities. Each type of asset class has its own risk and return features. Asset classes are fundamental to the investment concept of diversification. 1.1.2.4 Diversification. Diversification is a strategy used in investment portfolios and pooled investments. It combines asset classes and investments within those classes to spread out investing risk. Therefore, diversification in a portfolio lessens risk, based on the well-known theory of not putting all your eggs in one basket. Diversification can be accomplished in many ways. It could be through buying stocks of a wide range of industries or companies, and bonds with varying interest rates. Another form of diversification uses foreign investments to take advantage of different economic conditions in other countries. This spreads risk over national and foreign investments and their respective economic conditions. When an investor buys into a pooled investment, like a segregated fund, he automatically receives the benefit of diversification. Each segregated fund is invested in a wide range of investments, specific to its type. For instance, a bond fund is diversified across a broad spectrum of bonds in its portfolio that mature at different times, have varying degrees of risk, and make payments at different interest rates. Other investments that offer similar diversification include mutual funds and exchange-traded funds, ETFs. When an investor buys one stock or bond, or 10, or even 100, he is not receiving the full benefit of diversification. Point 1. Risk is centered on performance of those individual investments. If they lose value, there are not sufficient offsetting investments to compensate for losses. Therefore, it is very difficult for an individual investor to achieve diversification unless he invests in a fund-type investment. Most investors simply do not have enough investment capital to be able to achieve adequate diversification in a portfolio of their own stocks and bonds. Those that do often rely on investment professionals for frequent advice. 1.1.2.5 Liquidity. Liquidity describes the ability to cash in, or sell, an investment quickly at or near its current market price. An investment that has characteristics of liquidity is called a liquid investment. A savings account is a liquid investment because some or all of its value can be quickly accessed for use. An investment that does not have characteristics of liquidity is called illiquid. Real estate is often cited as an example of an illiquid investment since considerable time could elapse between the sale of a property and receiving its proceeds. Liquidity is essential in an investment when a part or all of its value will be used to provide an emergency fund to an investor. An emergency fund is a portion of earnings set aside for emergency purposes, such as when there is a sudden need for income due to an unexpected job loss. When such a need arises, the investor must be able to quickly and easily sell his investment and obtain its highest market value. 1.1.3 Time value of money. The present value of money is one aspect of the principle known as the time value of money. The future value of money is the other. It is very important to understand the differences between the two. Both principles are based on the potential for invested money to increase in value over time due to interest being earned. They do not consider investment growth due to other factors, such as capital gains. 1.1.3.1 Present value. Understanding present value, PV, and being able to calculate a present value sum is essential to many financial planning activities. Present value works backwards from a future date. It answers the question of how much is needed now to achieve a future savings goal. Therefore, it would be used to help a person determine how much needs to be saved today to yield specified retirement savings at a future date. Likewise, a parent who must meet future post-secondary education costs for a child could be provided with that information from a present value calculation. Present value tells us that if $5,000 is needed at a future date, then less than $5,000 needs to be saved today, because today's sum will earn interest and grow over time. The higher the interest rate, the lower the initial sum of investment needs to be. The present value calculation is performed when the future sum is known, the future date is known, when the sum is needed, and when the interest rate between today and the future date can be specified. Present value is generally calculated using a calculator, through an online resource, or with software provided by insurers. It applies to both a sum of money and cash flows. The formula for the calculation is PV equals FV divided by 1 plus interest rate, N. FV is the known future value and N is the number of periods for the calculation. Example: Julie wants to know how much is needed today to provide $5,000 in 5 years. Given the current annual interest rate on savings of 3%, the present value of $5,000 in 5 years based on 3% interest earned is $4,313.04. PV equals $5,000 divided by 1 plus 0.035. Julie needs to invest